that Alaska flight. A mixed picture, really, when it comes to some of the numbers coming out of Airbus. Deliveries, yes, coming in lower than estimates, but 2023, they managed to beat their own targets. So we'll certainly deep dive into the aviation sector. We'll have our colleagues available to us shortly to talk about that. We'll also have the auto sector in focus. We had numbers from Stellantis, as you point out, also numbers from Renault. So lots to talk about where EVs goes, where that story is developing, and where it is not. Where is it standing up to the US and the Chinese competition, for example? So we're open across European equity markets right now, looking for some of these corporates that have been reporting over the past 24 hours to stand out to the upside. Initial moves higher then across European equity markets, up by 0.1%, Chrissy, on the Stoxx 600, I can see. The FTSE 100 out of the gates pretty strongly to start the day, up by around 0.2%. Looking for the early moves around sectors, things still settling down, but we are stronger out of the gates for the start of trade.
Yeah, and we'll talk about some of those individual movers. Airbus already right out the bat down about 2% on their guidance being cited as a key disappointment from analysts on both sides of the Atlantic. Remember, they're talking about some of that positivity that you were supposed to see off the back of Boeing. Well, it looks like they can't actually capitalize on that because they're dealing with so many other issues and now delaying some of their deliveries.
Yeah, 2024 guidance looking a little weaker. The adjusted EBIT line in particular seems to be where the market might find that negativity. And this is a business, just like others, that's been dealing with parts shortages. So as well as the issues specific to the plane manufacturing space, there are also broader issues around parts shortages, also issues with their Pratt & Whitney engines on the A320neos. So these are planes they've been taking bookings for a very long time, but they're having to deal with some of the engine issues around Pratt & Whitney there.
Well, speaking of engine issues, we should mention one of the top performers in the Euro Stoxx 50 actually is Safran, which I'm recently learning is pronounced Safran. Their guidance coming in pretty strong, actually. Remember, they are in the supply chain for both Airbus and for Boeing as well. They're talking about some key positives there from the analysts, saying that there is 2024 guidance that is positive. I'm curious, though, if you start to see the delays in Airbus, the delays in Boeing as well, to what extent does that echo throughout the supply chain? It doesn't look like it's an issue at the moment, Anna, but it is certainly something that we're keeping an eye on.
We are, of course, at 8 o'clock getting the opening of the gilts market. And just to point out, of course, we had that data out of the UK economy at the start of the last hour. Confirmation that we were in recession the second half of last year, 2 quarters back-to-back negative growth. Gilts opening then higher, as you would expect to see in that context, and 10-year yields dropping a little bit as a result of that. Clearly, there's the global story. There's what's happening with US inflation and the global picture around central banks trying to tackle inflation in the last mile and the difficulty bringing that down. But is the picture in the UK deteriorating, or did it deteriorate more than had been anticipated? The Bank of England was already braced for something that was flat to negative, so perhaps not a million miles away from where they were expecting it to be. But certainly confirmation this morning that we got that recession in the UK is certainly something to watch, and markets are watching.
Yeah, another one that I just want to quickly bring up this mover as well. We're talking about Renault in particular, seeing some big moves there, higher by anywhere between 2 to 3%. Remember, they all have 2 different listings here, so it isn't, one listing, excuse me, for that. Higher by 2.3% is what I meant. An interesting dynamic there because they're talking about a pretty big dividend, and it looks like it's coming back to that idea of how do you keep those shareholders engaged with your stock, despite Renault also dealing with a little bit of those margin challenges that you are facing as well. So again, something to keep an eye on in the industrial space.
Yeah, absolutely. So lots out from the auto sector, plenty out from the industrials as well. And let's go to that theme now, and aviation in particular. We're joined by Benedict Camel, who leads our global aviation team and can talk us through what we're hearing from Airbus this morning. We got the numbers from Airbus then, Benny, down, the stock responding negatively, down 1.3%. My eye was drawn to that adjusted EBIT number, that guidance there for 2024. Did that look a little weak? Is that what's weighing here?
Yes, you're absolutely right. That seems to be the consensus among analysts looking at the stock this morning. Everyone had hoped for a little bit more across the board. They came out with a target for 800 aircraft deliveries for this year. Again, the consensus was slightly higher. Free cash flow, again, people had maybe hoped for a little bit more than that. One thing to remember, though, is that Airbus likes to go into the year with a fairly conservative guidance, both on deliveries and then on free cash flow. If you look at what they did last year, they came in pretty low and then managed to beat that quite handily. So again, with the deliveries, they had a couple of years when they missed those, and I think they've been burned by that, and they want to come into this a little bit conservative. We heard from the CEO Guillaume Faury this morning, and the overall tone is this is still a market that is adjusting to the new reality where we have really high demand from the aircraft, from the airlines, but the supply chain still remains strained. We also heard from Safran this morning, and they had similar comments saying the supply chain isn't back to normal. Yes, we're well out of the pandemic, but we're still trying to adjust. So all of that is leading to a slightly more conservative outlook and weighing on the stock.
Benny, there was a kind of a question that perhaps there might be some extra gains for Airbus, given some of the struggles that Boeing is having. They could capitalize on some of that market share. Is there any indication that Airbus is going to be able to do that?
I think that's generally the expectation now. The company is obviously very careful not to seem sort of gloating or sound as if they are really benefiting from this. Faury, the CEO, came out a couple of days ago and said they were humbled by what happened at their competitor at Boeing. At the same time, don't forget that Boeing is really kneecapped at this point. Their production and output targets are essentially capped by the FAA at the moment, while Airbus can march ahead. So obviously investors are looking at this. They're seeing that big number, the 800 that Airbus has put out for this year, much in excess of what Boeing can hope to do. While it might remain a little below what people are hoping for, it shows you that we have a widening sort of divide between Airbus and Boeing, and this is really a year where Airbus can capitalize on this.
Benny, thanks so much. Thanks for joining us. Benedict Gamel, who leads our Bloomberg Global Aviation coverage. Thanks for joining us with analysis. And coming up on that subject, we should tell you, we'll be speaking to the CEO of Airbus. You just heard his name mentioned, Guillaume Faury. He's going to be talking to the team at 10:30 a.m. London time. So plenty more to come on the aviation space, from aviation to autos, Chrissy.
Yes, from autos, it's all about the margin story again. You just heard Benedict talking about it in the aerospace sector. But when you talk about autos, it's so important to keep in mind that we're talking about U.S. resilience. We're also then talking about this idea of how much the strikes in the Detroit 3 actually ate into a lot of those margins as well. I want to dive right into it here. I want to bring in Elizabeth Berman, who leads Bloomberg's EMEA Autos coverage. Elizabeth, a pleasure to have you on the program. Before we get into the Stellantis story, which I'm fascinated with, let's go into Renault first. One of the big movers this morning. Walk us through what investors are responding to.
Yeah, earlier you mentioned keeping investors happy, and Renault achieved that by announcing the biggest dividend since 2019. They were also talking about pretty solid margins into an environment where the electric vehicle uptake is slowing, and companies need to react to that. Renault has a slew of new models coming out, a lot of them somewhat higher up in the space in terms of margins. So that was certainly keeping investors happy.
Okay, and on the Stellantis side then, Elizabeth, we see that stock performing well this morning, up by more than 2%. More talk of returning cash, despite all the issues around strike activity. What stands out to you from Stellantis?
It's very interesting that the company announces a €3 billion buyback when just a few months ago they were arguing with striking workers in the US that they really didn't have anything to spare to pay them higher wages. But the shares are certainly reacting to that announcement, of course. More interestingly, operationally, I would point to a lot of commentary from Stellantis this morning about managing costs, about managing margins. We already saw in the second half of the year last year, that margins had come under pressure, and that wasn't just in North America, that was also in Europe. And of course, 3 years ago, Stellantis emerged with 14 brands after the merger of PSA and Fiat Chrysler. And this morning on one of the media calls with the CFO, she was talking about logistics and raw material costs as being positives for the company, rather than pointing to more synergies from that business. So that's going to be pretty interesting for Stellantis, which has been losing market share in North America and in Europe, potentially putting them on a somewhat weaker footing as they compete in the EV transition.
Well, speaking of that EV kind of transition away, it feels like from a fiscal point of view, there's been so many governments around Europe who are saying, well, this is looking a little bit expensive. Maybe let's just pull back on a little bit of some of the credits and the taxes associated with that move. Do you think there could be some sort of, forgive the pun, reacceleration into their EV strategy?
The EV slowdown and the trajectory of hitting those CO2 reduction targets is certainly what we're focusing on this year, and how that's going to play out in reality. So the limits for CO2 emissions have been set by regulators with faraway deadlines. Now these deadlines are coming closer, and it's also becoming apparent that keeping paying incentives to consumers to buy EVs is going to be very expensive. So we're really gripped by how regulators will react, by how car makers will react to this, because certainly there, and we already have seen this, there will be changes in strategy here.
Elizabeth, thanks so much. Thanks for joining us. Elizabeth Behrman in Munich, who covers the auto sector, and thank you very much for joining us. Sticking with the car makers, we'll be speaking to the Renault and Stellantis CEOs later today. Those conversations coming to you on Bloomberg TV. Let's get to those and other individual stock movers. Plenty to choose from this morning. Joe Easton has a briefing. Joe?
So here's Airbus at the top here, down around 0.1% at the moment. It was down more than 1% right at the open of trading. They did miss on their order guidance for the year, but it's only slightly below expectations at around 800 versus consensus of 813. Financial guidance, a big miss. No buybacks, so some clear underperformance nonetheless in the stock today. Critty mentioned Safran, the big aerospace supplier. That one doing well, some good margins on that, so coming up around 3%. And then in cars, Renault and Stellantis both gaining today as expected by those early calls. Renault was the strong one of the two and is doing slightly better given the strength in some of their EV outlooks at the moment for Renault. Then we'll flip over and have a look at another big one out of France today. It is EssilorLuxottica, the maker of Ray-Ban, some weak sales guidance from them. They also do prescription glasses as well. That tends to be more stable, but it looks like it is the sunglasses business that is weaker. That ticking higher as I speak now. And in the drink space, finally, good news out of Pernod, an upgrade to some of their commentary on their outlook. That sector has been hammered by the over-inventory in drinks, so that one a positive surprise, up 5%. And a massive gainer is in chemicals. DSM announcing they're going to spin off their nutrition and animal health business. Very unexpected for that one. It's one of the best performing stocks we've got today, up almost 12% for the chemicals company in Amsterdam. But a big decliner over in Sweden. Video games getting hammered. They do some this is Embracer. They do fantasy games, that kind of thing for the company there. That one down 12%, the worst performer on the market today following earnings out of that company. Then we've got a couple of banks. We did do Commerzbank in the stocks to watch. That one was looking positive at the open, up around 2% now, given that guidance on their fees and wealth income. But a big dropper is Close Brothers in London, scrapping their dividend due to an FCA review into car motor financing. Potentially there's going to be billions of dollars, billions of pounds worth of compensation to people that may have been missold loans for their cars going back several years. The FCA reviewing that, Close Brothers scrapping their dividend as a result. Then a couple of morning calls to get through, both of which are recovery stories. Goldman Sachs recommends buying shares of Deutsche Post, also known as DHL, as they think the freight market has bottomed and that should start to recover soon. And then in terms of UK housing, we get Kingfisher, the owner of the B&Q DIY chain. This one gets a buy at City. They think you should be buying into DIY as the UK housing market starts to recover. So that one is Kingfisher and gaining around 2% this morning.
There's some interesting macro calls, aren't they, Joe? Thanks very much. Joe Easton from our equities team with that really interesting call out of around Deutsche Post from Goldman Sachs. A lot of people watching that kind of logistics business for clues around the global economy and the housing market in the UK of interest as well, of course, with that in mind. Let's just focus in on some of the macro lines we're getting out of the ECB. Christine Lagarde about to speak, some comments that she will make already crossing the Bloomberg terminal around the economy, and as she has in the past, putting the focus on wages.
Yeah, and really saying that wage rises may be in part buffered by profit margins in the context of the earnings stories that we're talking about, where some margins are being hit by that wage story. This is a really interesting thing. She's actively talking about the corporate space in terms of the macroeconomic outlook. She's also saying that wages are becoming increasingly important as inflation drivers. No surprise there. We kind of knew that was happening. And the services inflation is where the persistence lies. Really sticking, again, confidence that inflation will ultimately head back to 2%. But again, Anna, I'm going to circle back to this corporate story. The wage rises in part buffered by profit margins is fascinating to me.
Yeah, absolutely. So she's suggesting there that there might be an ability by corporates to pay up for wages. I wonder how those wage demands go down in the C-suite, though, when inflation is coming down. It isn't the double digit that we saw a year ago. It's down to, 4% in some places and below in some parts of Europe. So we'll certainly watch how that one develops. They are going to be data dependent, as they always tell us. They still talk about needing confidence that inflation is headed for 2%, which echoes exactly what we've been hearing from the Fed and other central banks. But we're bringing you live images from Brussels, where Christine Lagarde, the ECB president, is due to deliver these remarks. Some of those already on the Bloomberg terminal. We'll bring you any other breaking news. We'll have analysis of the markets when we come back. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
some of the dividend yields on offer in Europe, and then you add on another 1.5% to 2% on buyback yields, that's 6-7% of income that investors are starting with before they need to worry about share price volatility. So I think take these numbers as you see them. This is a sign of corporate confidence. And I think most interestingly, we have a great chart on this in our pack, which shows how historically, US buyback yields have tended to be 1.5, 2 percentage points higher. So in the past 6 months or so, where European CEOs are maybe saying, hang on a minute, our valuations look pretty discounted. Perhaps it's time to start buying back some shares.
JP Morgan Asset Management's Hugh Gimber there talking about this buyback story, because it's a theme that you're seeing in the corporate earnings space on both sides of the Atlantic, but specifically in Europe. You're seeing more dividends. Even just this morning, the amount of money going into the European stock market just from the earnings picture, just from these corporates as opposed to international investors, to me, is stagnating. Doesn't then distort the market. Let's ask an expert on the subject. Virginie Maisonneuve joins me this morning. I hope I got the pronunciation right. She, of course, is Global Chief Investment Officer for Equities at Allianz Global Investors. Does this distort the market? How are you thinking about the buyback dividend story in corporate earnings right now?
So we really don't look at it for the market overall. We look at it for individual companies. So if you look at Apple last year, I think 70 billion buyback, supporting EPS by 2 to 3%. So I think that's an important item to look at. Overall, though, it sends you the message that companies believe that their share price, clearly there's value in adding and taking stocks back because they see the value of it time. And probably, if you look in the U.S., I think the number year to date is around 170 billion last year, 190. So we're in line. And of course, the big quality, profitable tech companies have been very good because they're generating a lot of cash flow. So an important element, but not only a top-down picture one. It's bottom-up, stock by stock.
But the liquidity picture, I think, is so relevant from the buyback story as well, because there's so much more liquidity in the U.S. markets than there is in the European markets. So from an investor's point of view, if you're seeing corporates hop into this, are you then more concerned about simply demand-supply dynamics as opposed to the actual earnings fundamentals from some of these companies?
I think for us, it's really combining those two. Now, of course, if you're talking about a small cap where buybacks are actually a bit less common, that might have an impact on liquidity. But if you're talking about a mega cap, I think in general, this is just one factor. But it's definitely not a reason to buy a stock, but it tops up. If it's a stock that you like that has decent earnings per share and good valuation, it tops up to the attractiveness of the stock.
Okay, Virginie, good morning. Let me ask you about some of the themes that have been dominating market conversation. Obviously, the Magnificent Seven is one of those of late. But where the US has Mag 7, the Europeans apparently have granolas, which is very confusing to me because I'm a big fan of granola. I'm not really sure if this is how this is supposed to influence my thinking on these stocks. But this is a real mixed bag of stocks that Goldman's and others put together to describe them. I mean, you've got GSK, Roche, Novartis, all fine healthcare, but then you've got some chip-making equipment companies, you've got some other healthcare, you've got some French luxury. Does this make sense as a basket to you? Do you have a single view on the basket, or is it all around the individuals?
No, it's all about individual stocks. And even in the Mag 7, if you look at performance, you see some real differentiation. So if you look at Tesla, Apple versus Meta year to date, etc. So ultimately, we are if you're fundamental or even a quant, asset manager, when you're picking stocks, it's the valuation of each stocks. I think if you look in the multi-asset space, clearly people might be looking at this kind of baskets, but it's an interesting way to look at it. That little basket, actually, 80% of their revenue comes from outside Europe. 10% from China, about a third from Asia. So you're talking about a European basket of globally competitive companies. And as you said, from luxury to healthcare to semis, it's a mini index.
Yes. I mean, one sector that's not represented there, and possibly for good reason, is the auto sector. We've had a host of reports out from the auto space this morning. But one of the key themes seems to be, and it's kind of crept up on us quite quickly, the extent to which demand for EVs is challenged either by economic fundamentals or by a lack of infrastructure. How do you look at that sector, Virginie?
Well, I think, you go back to basics. You think about COP28, you think about climate, you think about our inability to get to 1.5. And along the way, there are several strategies. We know renewable, we know autos is one of them. So there's an adjustment factor going on. At the same time, traditional cars are becoming more and more efficient. So we also have to look at this. But the infrastructure for EV absolutely needs to continue to develop. Yeah.
Let's talk a little bit about supply chains here. I feel like I'm having a little bit of 2021 deja vu. One of the themes we've been waiting for in this earnings cycle is some sort of bigger read-through from the tensions in the Red Sea and arguably in other parts of the Middle East and arguably even in the Asia Pacific. Over and over again, we've had CEOs on this program come in and say, there is no read-through. We're not seeing it yet. Could we see it in the next quarter?
I think you could. I think, of course, it depends on what goods are going through there. And as you know, there's been, probably because of the experience of COVID, a pretty fast adjustment in terms of being used to disruption. That's what I mean. Yeah. Going around, South Africa and delivering. Of course, it lengthens the time, it increases the cost, but there has been an adaptation that, the one point, though, that I think is very important to remember is I really think that geopolitical factors will continue to wait for the years to come. We're in the process of this new world order developing, and I've talked about it around China phase 3, and you're seeing it with, disruption around election and patterns and popularism, etc. So I'm not forecasting another Red Sea. What I'm saying is I think leaders and companies are getting used to functioning in a disruptive environment, and that's part of the quality of certain companies.
But in terms of these rising tensions, there's a big question about what the European defense sector actually looks like. Yeah. So many big names here. When do we see that kind of infrastructure spend in the defense sector from NATO, from the other European colleagues, even from the United States that are then investing in European kind of manufacturing? When do we see that sector take off?
Well, I think it's interesting. As you know, there's a couple of things here. The first one is for sustainable investors, many of those stocks are on the exclusion list. That's one point. The second point is there's a blend that has been in the making for a while now between tech companies and defense companies, as we see in Ukraine. A lot of tech is used in warfare, right? So the boundaries are blurring there. But I think in a world that's more fragmented, a world that's more disrupted, we should expect higher defense spending, right, around the world. And that will impact, of course, markets, but also some of the enlisted companies.
Okay, Virginie, thanks so much. Thank you very much for joining us here in London. Virginie Maisonneuve, a global CIO for equities at Allianz Global Investors. Really important point that Virginie makes about, C-suites getting used to global disruption. We talked about this the other week, didn't we? With a number of CEOs actually suggesting that's how these things feel. There's sort of crisis, polycrisis after polycrisis, and they're getting used to handling those.
Yeah, I love how she talked about the marriage between tech and defense here, because I think what a great example this morning when we had RELX, we had the C-suite talk join us this morning. It's technically viewed as an AI stock. They have that cybersecurity element into it. It's also one of the biggest gainers in the FTSE 100 this morning.
Coming up on the programme, we'll get back to some of the macro conversations. The UK confirmed in recession in the second half of last year. We will deep dive into that data next. This is Bloomberg.
On the product may read made in the USA, but the sign on the CEO's door often says made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today. We're about 30 minutes into the European trading day. There's a little bit of macro, a little bit of micro. On the macro front, you had those UK GDP numbers suggesting we were in a technical recession in 2023. It is official. But the micro, I would say, is stealing the stage or stealing the spotlight, if you will. You are seeing a little bit of a mixed picture with some of these earnings. Let's walk you through some of what we're seeing. The gainers, for example, are a mix. Pernod Ricard, for example, the drink maker, talking about, even though they missed sales, even though they missed their profit, the guidance going into the back half of the year seems to be what investors are actually really holding on to. We moved there by about 6%. Renault, for example, also coming up a higher. Stellantis as well, even though they're talking about hits to their margin from some of the strikes going on in Detroit. The buyback story, rescuing them both. Shares higher by over 4% for both of them. And even Safran, which of course is in the supply chain for the likes of Airbus and Boeing as well, really saying that some of those supply chain issues that you've seen on the surface for those two mega weights, is what I'm going to call it, isn't actually reflecting in their earnings. They're actually really being smiled upon from the investor standpoint. Those are some of your biggest gainers. Let's talk about some of your biggest losers this morning. Embracer, I'm sure I'm butchering the pronunciation there, but it is a Swedish luxury goods company, down 13%. It's also one of your biggest weights on the stock 600, which is quite interesting. It looks like they are missing on some of their margins as well and their operating numbers. Another kind of major sector that you're keeping an eye on is the energy sector. Remember, we've seen some outperformance here in a little bit, so this could simply be a function of taking profits. You're also perhaps seeing it in line with some of the oil move, although oil only down 0.6%. But nevertheless, the the stock 600 energy sector, down 1%, as well as the likes of BP and Shell, which are in fact your biggest weights on the stock 600, Anna.
Yeah, interesting to see where oil is, 80.94, a little bit weaker than where it's been recently, but not a million miles away from where we started the week. So that's where we are on stocks and across the commodities space as well. Kwiti, we started the program talking about the UK growth story, and we've had a little bit of time to digest what we got there, but we've had confirmation essentially that the UK economy was in contraction territory and was in recession the second half of last year. GDP falling by 0.3% in the fourth quarter. That was more than the 0.1% drop that economists have forecast. So this number came in worse than had been anticipated. But what does that mean for the rest of this year? We spoke to Hannah Slaughter from the Resolution Foundation.
it could be the case that we see kind of maybe a recession kind of at the end of 2023, and then also maybe a bit kind of early 2024, and then kind of quite quickly return to positive growth. But again, we're not expecting kind of a return to really strong kind of meaningful growth, you know, in the short to medium term.
Let's get another voice on the UK economy. Anna Andrade joins us from Bloomberg Economics. Anna, another day, another piece of UK data. We spoke to you yesterday on the back of the inflation numbers, and of course we had wage data out earlier on this week. So confirmation of recession for the UK economy. Take us underneath the hood on some of these numbers, if you would, because I thought we were just waiting for the December number. The December number then didn't look all that bad, and yet the quarter looks to have disappointed. What's happening here?
Hi, good morning. Yeah, I think prior to this release, there was a bit of an expectation that the data was going to show that the economy was in a technical recession, but by the narrowest of margins. So it would just sort of be kind of a technical recession on paper, if you like. And what we got today, at least my reading from the data, is that we actually saw a little bit more than that. So what we saw, as you say, December wasn't that bad, but October, the October data was pretty bad. So instead of falling by 0.3%, as we initially thought, it fell by 0.5%. So that made that the quarterly fall at the end of last year was bigger than we expected. So it was 0.3, we expected 0.1. It was an even bigger miss from the Bank of England's forecast that saw no growth. And then when you look at the details, that's when you really start to see more signs of underlying weakness. So on the one hand, you had market sector output, which excludes government activity, falling for 3 consecutive quarters. And then at the same time, and you know, that was first explained by a fall in investment, then by falling household consumption. And then in the second half of last year, you essentially had household consumption falling by 1%. Now that's a little bit, it's not as a big, deep downturn, but it's a little bit more than just a technical recession.
Anna, break down the numbers first, though. Where is the weakness in this UK economy here? If we are seeing a technical recession, what dragged it down the most?
Well, I think a lot of it can be attributed to high rates right now. So we had high inflation, you know, maybe at the first half of last year, a little bit of in 2022, kind of waiting on the economy. So the economy has essentially been flatlining for more than 18 months now, and that initially was explained by high inflation. Now the story of 2023, I think, has been more of a tight monetary policy weighing on the economy, and you look at the data, and that's what it shows you, because it actually shows you that government sectors actually did well, health in particular, but the private demand that it's more sensitive to high interest rates didn't do that great. So it has been a lot of weakness in construction, in private consumption. So that kind of just tells us that monetary policy is having an effect.
Anna, thanks so much. Thanks for joining us. Anna Andrade from Bloomberg Economics with her take on that data out this morning on the UK economy. Let's get to some of the other top stories and well-read stories on the Bloomberg terminal this morning. The British lender NatWest, staying in Britain first, is said to be preparing to install Paul Thwaite as permanent chief executive. That is according to reporting by Sky News. Thwaite has been in the job on an interim basis since predecessor Alison Rose abruptly departed last year. However, Sky says the board hasn't made a final decision and other candidates have been discussed as part of the appointment process. We get ready to hear from NatWest shortly on results. Morgan Stanley is said to be planning to eliminate several hundred jobs, the first such move under the new chief executive, Ted Pick. The cuts will affect less than 1% of employees in the wealth management business, which has about 40,000 workers and is the firm's largest unit. And Lyft CEO David Risher has taken the blame for a typo that unintentionally inflated the company's earnings outlook and sent shares soaring on Tuesday. The firm's press release initially said its margin would expand by 500 basis points instead of 50 basis points. Risher told Bloomberg the Lyft team was taking the error seriously.
Well, look, first of all, it's on me. There are a lot of eyes on this press release, but at the end of the day, my bad. But look, I don't want it to take anything away from the butt-kicking performance that the business did, thanks to all of our employees and thanks to millions of drivers. I mean, look, we had our financially strongest quarter we've ever had, and I'm super excited about it.
the CEO of Lyft there. Chrissy, really interesting. You know, unfortunate, the typo, unfortunate, disappointing, I'm sure, for some, or not, if you managed to make money on the after-hours trade that we saw there. But really interesting from the Lyft CEO trying to turn our attention to the underlying performance of the business, which was a point that our colleagues at Bloomberg News and we were making yesterday. But also interesting that I've seen a number of sort of corporate finance commentators suggesting that actually they handled this pretty well, that mistakes do happen, and if you get out there quickly, correct them, you know, that this is the way that this kind of thing should be handled.
Yeah, taking full responsibility, saying that the CFO's job is safe for this typo, and that even saying that the press releases are still written by humans and not by AI yet. So there is going to be some element of human error, but it was also funny, he goes, it was just one extra zero. But a lot of investors would say that one extra zero means a lot. So I thought it was quite funny. But again, to your point, a lot of credit to him for taking full ownership. And he's right. There was some butt-kicking performance in the Lyft numbers.
Just depends where you put that zero, doesn't it?
It really does. But I mean, even a 50 basis point, I think, margin increase is what they talked about, is actually pretty important for Lyft and Uber, by the way, which have both been pretty good numbers.
Yeah. Okay, let's move on to the hedge fund story, shall we? I know this is something you've been thinking about overnight.
I do. I dream about Warren Buffett at night. This is what I do. But it's really interesting because we're starting to see the AI theme again kind of seep back into it. Hedge funds bringing in some of the biggest technology names in the fourth quarter, chasing a rally fueled by, we said it, AI growth. That's according to the latest quarterly reports investment managers filed with the U.S. SEC. Up all night is Charlie Wells, joining us now from our wealth team. All he does, as I dream about Warren Buffett, he actually goes through the filings. What did we know? What did we learn thematically here?
Yeah, so look, we have gone through 835 13F filings, and the deadline for those was yesterday. This is the sort of I know what you did last quarter document, because we basically look back at the end of last quarter and we see what these hedge funds bought and sold. And as you say, Kriti, it really was this kind of AI tech-oriented pickup. I mean, you look at Amazon, so that was the largest ad. Hedge funds added $22 billion worth of Amazon. We also saw big ads of Intel, big ads of NVIDIA, of course. Investors are going to be happy about that. But it was a slightly more complex tech story. So one interesting name here was Meta, and we saw $6.6 million dropped in Meta. So that could indicate potentially some profit taking there.
Okay, so that's what they're doing with some of those big tech names. AI does seem to be a theme, though. Is that what we're seeing when we're tracking where these big names in finance are putting their money? Is that what they're doing, following the AI drama?
Yeah, we get to look at the smart money, some of the individuals here. I think, you know, Michael Burry is a really interesting one to look at. We get to see what he did last quarter. And look, he's known for contrarian takes, right? Bet against the housing market back before the financial crisis. Interestingly here, he seemed to pick up some big China names. So the largest holding at Cyan Asset Management, his hedge fund, is Alibaba. The second largest is JD.com. Now, that's a really contrarian take. You know, investors have really been fleeing China. And so far this year, those names are not doing great, right? Alibaba down about 5%, JD.com down about 20%. Interesting, also, we can think about Buffett. Kriti, I know he's one of your favorites to think about. And there, he sold about 1% of his holdings in Apple. So that was a striking one and adds to some of the nuance on tech, right? So they're huge interest in AI, but a little bit of shifting around the edges on some of these other big names.
I love two parts of the story. First off, Michael Burry is actually, in a lot of ways, in line with what you're seeing with some of these other kind of corporate names, right? He's leaning into e-commerce names in China when everyone else's their biggest bet is Amazon, so an e-commerce name in the United States. So it's more of a regional story, which is interesting to me, despite the PBOC continuously trying to stimulate that market. Warren Buffett, you're right, I'm obsessed. He's great. The Berkshire bet has always been about what value stock does Warren Buffett pick next? Railroads, Coca-Cola, Apple was this big one. Is Apple a value stock at the end of the day? Trimming that back but not making any new bets is really interesting to me. I'm curious, is there a macro read-through, or is this just Apple's rallied too far? Let's take them some profits.
I think that's really striking. I mean, it's difficult to say. I mean, we know that he has, you know, made some of those really big bets in some of the oil transport names recently. And I think the other question about Berkshire is, what do they do with that huge cash pile? I think we don't get a read-through from this, but, you know, we are seeing that he's got a lot of power. The idea that there could potentially be a potential acquisition, we know before Charlie Munger passed, he was talking about the potential for maybe an acquisition, you know, that there was a fairly good chance that could happen. But we'll be hearing soon from Berkshire Hathaway in an investor letter about where things stand.
Okay, always worth poring over the details of 13F. Or if you don't have the time, then here's Charlie Wells. He does it for you. Thank you very much. Charlie Wells with the details of those 13F filings and what all of that money is up to. Coming up on the programme, we will talk about geopolitics, a number of themes to pull together here. NATO defence ministers meet today for the first time since Donald Trump's controversial comments on the alliance. We take a look at the Republican presidential frontrunner's plans for a NATO makeover next. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Could face bigger challenges elected.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make.
This is Markets Today. We're about 45 minutes into the European trading day. Things are looking on the up and up when you look at the European stocks picture. A lot of this has to do with the earnings numbers. Some out performance in the earnings. Some are buybacks. Of course, a mix of that all shaking out. But one theme that we haven't actually talked about is what's going on in the geopolitical picture. Several developments overnight. We start in the Middle East, where 3 key U.S. allies have cautioned Israel against a planned offensive in the southern Gaza city of Rafah. The warning from Canada, Australia, and New Zealand, all longtime supporters of Israel, came as Prime Minister Benjamin Netanyahu pulled out of talks on securing a ceasefire with Hamas. He dismissed the militant group's demands as, quote, delusional. I want to get a little bit more insight here. Bloomberg's Paul Wallace joins us from Dubai. Paul, talk to us about these concerns. They've been mounting for a while. Why now to speak up?
Yes, they have been mounting for a while, and I think it's because there's just such a huge amount of concern among the international community, including Israel's close allies, about what happens next in Rafah, this city in the southern Gaza Strip that is where a lot of Palestinian civilians fled to at the outbreak of the war in October, because that's where the Israeli military told them to evacuate to. So there are more than 1 million people there, roughly half of Gaza's population, more than half of Gaza's population by most estimates, and they really have nowhere to go to. They can't go into Egypt, which is close to Rafah, because Egypt is not opening the border to them, and the rest of the Gaza Strip to the north has been devastated by war, and Israeli military activities are continuing in many places. Israel has said that if there's any attack on Rafah, it will allow civilians to leave the city beforehand, but there's a huge amount of skepticism worldwide that Israel will be able to do that to ensure, and in a way that gets many people out safely.
Okay, so Israel's traditional allies warning them against their plans with regards to Rafah. The United Nations speaking about this also and suggesting that this could lead to slaughter in Gaza and leave a humanitarian operation at death's door. So those are the warnings. If we were looking for talks to deliver some sort of solution here, Paul, then Israel has pulled out of certain talks. Tell us the rationale there.
Yeah, so these are talks that are taking place in Cairo that are being mediated by the Egyptians, the Qataris, and the Americans. And Israel sent its top intelligence officials, the head of Shin Bet and Mossad, to Cairo on Tuesday. They went back to Israel and briefed Prime Minister Netanyahu on Tuesday night. And he then told them that they and no other Israeli delegates should go back to Cairo for follow-on talks scheduled for today. So that essentially breaks the talks as far as we and everyone else can tell, because these talks they're not directly about Rafah. They are about getting a ceasefire in place and the release of some, if not all, of the 100-odd hostages still being held by Hamas in Gaza. But with Israel not there and Netanyahu saying that Hamas's proposals so far are delusional, it seems we're very far off from a ceasefire proposal. Netanyahu has indicated that he's not totally against a ceasefire deal, that he may change his position if Hamas does. So this could be a mere pressure tactic on Hamas, but as I said, it certainly doesn't look like any truce or ceasefire is imminent.
Bloomberg's Paul Wall is joining us from Dubai this morning. We thank you for that update on a growing conflict and, of course, a growing humanitarian crisis as well. And sticking with that geopolitical theme, let's go from the Middle East to right here in Europe. NATO defense ministers are meeting today with former U.S. President Donald Trump's recent comments hanging over the gathering.
I said, you got to pay up. They asked me that question. One of the presidents of a big country stood up and said, well, sir, if we don't pay and we're attacked by Russia, will you protect us? I said, you didn't pay? You're delinquent? He said, yes, let's say that happened. No, I would not protect you. In fact, I would encourage them to do whatever the hell they want.
Now arriving at the meeting this morning, NATO's Secretary General Jens Stoltenberg responded to Trump's criticism.
Article 5, the commitment to defend all allies and that an attack on one ally will be regarded as an attack on all, is the core of NATO. Any suggestion that we are not there to protect and defend all allies will undermine the security of all of us.
Bloomberg's Ellen Milligan is on site at the NATO headquarters in Brussels. She joins us this morning. Ellen, a pleasure to have you on the program. Walk us through some of these details about what some of the proposed discussions might look like from the Trump camp.
Well, yes, following those inflammatory remarks that you just played that Trump said at a rally this weekend, Bloomberg has reported that Trump allies have been discussing a kind of two-tier style NATO alliance, whereby countries which aren't meeting that 2% of GDP defense spending goal won't be applicable to the Article 5 part of the alliance's structure. And this Article 5 is key, as you just heard from Stoltenberg. It requires common defence of any NATO member if they are attacked. So those comments this weekend have caused a lot of concern among NATO members, among European diplomats as well. And this is despite Stoltenberg announcing yesterday that 18 of 31 NATO members are expected to reach this 2% goal this year. But even so, this rhetoric has definitely stepped up concern about how Trump's return, a possible Trump return, might impact this alliance.
Yes, and Eleanor, I suppose it's pushing against a theme that we already know very well from when President Trump was last in the White House, where he certainly was putting pressure on European leaders to increase spending on defence. So with that in mind and the recent reiteration of these comments from a once again presidential hopeful, how are European leaders responding to all of this?
Well, you just heard from Stoltenberg there, who I spoke to this morning and put this reporting directly to him, that, you know, this Article 5 sits at the heart of NATO. And he also, part of his response that wasn't shown just then was he really warned about any kind of pursuing of a path which divides Europe from North America, and hinting there that that's what Trump is potentially trying to do in this rhetoric. And we also heard this morning on the doorsteps at NATO headquarters from the Canadian Defence Minister, who urged to respect this collective alliance, from Germany's Defence Minister, who said he wasn't in the mood to continue commenting on Trump's rhetoric as well. So you're getting a real sense of concern, but also exasperation about this rhetoric that's stepping up from the Trump campaign.
Ellen, we've talked a lot about, or at least heard in these headlines, about what that could actually mean for some of these budgets and how close some of these countries are to meeting that 2% of their GDP target. Could we get more from the NATO defense ministers meeting today? What does that meeting look like?
Yeah, so today one of the big topics is going to continue to be burden sharing and making sure that those countries who aren't expected to reach that 2% target this year are on track to do so the following year, for example. We've been reporting this week about Europe's ability to make sure and to ensure that its military capabilities are sufficient enough, whereby if in the event that they cannot rely on the US to help them defend itself if they were to come under attack, that its military capabilities are there to aid itself. And so that's going to be a big discussion today. There's a big ammunition shortage that NATO members are concerned about. There's going to be discussions about joint procurement, for example, between European nations. We've already seen some deals come out this morning between Latvia and the UK about drones. So more of that. And I think there'll also be a discussion about broadening out of NATO's role. There's talks happening about them playing a more coordinating role in terms of support for Ukraine as well.
Ellen, thanks very much. Thanks for joining us. Bloomberg's Ellen Milligan with details from Brussels on what to watch when it comes to NATO. Chrissy, let's take a moment to think about what else we're watching in markets today. 1 o'clock UK time, Bank of England policymakers Megan Green and Catherine Mann will be speaking. So we'll see if we get any continuing hawkish language despite the weakness of the inflation and the growth data. At 1:30 p.m. UK time, US retail manufacturing data, all of that due out, as well as initial jobless claims. It's Thursday, so that's what happens. At 6:15 UK time, Federal Reserve Governor Christopher Wallace speaks. Then on to the US earnings stories, and I'll linger here for a moment. We'll get Coinbase, Applied Materials, Deere and DraftKings, and nothing much that unites all four of them. But interesting on the Deere front, I was looking at actually CNH Industrial, a European manufacturer, or rather, sorry, angry farmers in Europe, weighing on that particular tractor maker. So that could be something to watch when it comes to Deere, a new dimension, a new political force in Europe, very much flexing its muscles. And then Applied Materials, of course, chips always in focus.
It's always in focus. May I give a macro case for Coinbase, though?
we go.
Given the idea that we're talking a lot about, of course, Bitcoin and whether or not it actually sustained some of its gains, I believe trading above 51,000, now just shy of 52,000. Do we start to see any sort of cracks in the exchange space? Coinbase will give a little bit more guidance on that.
Okay, and we'll have a number of CEO interviews coming up today as well. So stick with us here on Bloomberg TV as we bring you some big name interviews throughout the day. We'll be speaking with the Renault, Airbus and Stellantis CEOs. So those conversations, no doubt, different in some senses, but some common themes certainly running through the auto story. The Ford CFO also joining programming. So the competition in focus when it comes to EVs, certainly for all of those automakers. We'll set Airbus aside, it's got its own issues, but that will be part of the conversation.
Yeah, and do we start to see the similar themes from the American car makers that we saw in Renault and Stellantis in their earnings story this morning? That does it for markets today. The Pulse is up next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The UK slips into a shallow recession the second half of the year. We'll dive into the details in our weekly UK show. Japan also unexpectedly slides into recession, failing to the fourth largest economy below Germany and prompting caution on BOJ bets. Plus, autos in focus. Stellantis warns of a turbulent year as car makers cut prices to compete. Renault though, forecasts steady returns as it overhauls its lineup to counter slower EV demand. We'll be speaking to the French company's chief executive very shortly. But first thing is first, let's look at the markets. Actually, let's look at the European markets map. Now, a lot of the focus has been what's been going on in treasuries and certainly what's been going on in the U.S. Now, if you look at stocks, they're getting a little bit of a mood higher, bit of a lift from, of course, the S&P reclaiming that 5,000 level. It was big news earlier on in the week. You can see for the moment the FTSE gaining some 0.2%. We're seeing similar gains. The DAX and the CAC 40 between 0.6% and 0.8% higher. Now, some of the other things I'm looking at, I know some of the U.S. equities yesterday certainly retraced some of the losses spurred by data showing that U.S. core inflation for January rose more than expected. So a lot of the focus here and a lot of the situation will be what happens with yields in the U.S. The other thing we're looking at for is a couple of other days across the world. Of course, we heard also from the U.K. that GDP falling 0.3% in the fourth quarter, more than the 0.1% drop that economists had forecast. This complicates things a little bit for the Bank of England. Also, the IEA saying that oil demand growth is slowing, while non-OPEC plus supply is actually climbing. This is an interesting dynamic that the Gulf nations will especially be looking at. So to talk about markets, earnings, to talk about U.S. inflation, now we're joined by Karim Shadid, Chief Investment Strategist for BlackRock's iShares division in EMEA. Karim, as always, thanks so much for joining us. What a week, right? We had the S&P at 5,000, questions about inflation, questions about jobs data, and now the UK in a recession. What do you think will drive markets forward?
Yeah, it has been quite the week, and I think it really shows us the inflation volatility in action, which is a key view for us, that markets are still sensitive to inflation data because markets are still sensitive to this idea that central banks are responding quite sensitively to macro data. So we've seen quite a big shift in the market pricing of central bank rate cuts this year, this week alone. Now the market's only pricing 3.9 cuts for the Fed this year, only just above 3 for the BOE. There's been some big moves in the rates markets, and it's really this macro risk theme that we think matters in the investment outlook this year.
But Karim, what have we learned over the last 6 days? Is it that actually, the U.S. economy can hot up a little bit more than expected, or that driving inflation down is not going to be in a linear move?
It's the latter. It's not going to be a linear move. We always said that last leg down from 3 to 2 or 4 to 2% is not going to be a straight line. Now, we still think there's a good chance that inflation will fall to target this year. The goods disinflation, the unwind from the pandemic, is very powerful this year. We still have pressure in services. We saw that in the US CPI. But that goods disinflation is going to trump the latter. So we still think disinflation is the theme. Markets will like it, which is why we're positive on US equities over the next few months. Treasuries, it's a bit more mixed. We like to be targeted, so we're tactical with our duration view. Our favorite bucket is the 3 to 7 year. We think that gives you the best risk reward. Whereas we're a bit more cautious the further out the curve you go, because risk premium has its role to play in terms of what investors are demanding.
And Karim, in terms of U.S. equities, again, there's the Magnificent Seven. If you're not a pure AI play, I think you fall a little bit behind, but how do you choose the sectors you want to be invested in?
It's actually something we're seeing a lot in the flow data. I like to analyze ETF flows because they're liquid, they're transparent, they give you a sense of the money in motion. And you see that dispersion is the name of the game when it comes to selectivity in sectors, in factors. So I look at the investor positioning over the past couple of months. December was a record for large cap US equities. January was all about tech and healthcare. So you have this targeted sector picks. So it's a bit of both. At a benchmark level, we're neutral on US equities, but when we add on the sector conviction, we become overall overweight because of tech.
I mean, you're the fourth market participant that's talked to me about healthcare this week. Is it getting overcrowded? Do you worry about valuations?
Not really, because actually we like to call healthcare the lovable laggard, because it has been...
I love that.
Yeah.
Like a teddy bear.
Exactly. So it's lagged. It's we've done, in the flow analysis that we do, we're seeing that positioning is starting to warm up in that space. So I don't think it's late in that trade. I think actually it's early.
What do you do with European government bonds right now? I mean, again, a number of forces at play.
So big difference between the Fed view and the ECB view. Markets are pricing more cuts for the ECB. We're looking at 4.5, almost 5. Again, those numbers change so quickly because of the rate volatility. But the ECB view is that they have a better chance at delivering on the market expectations of rate cuts. So once they start going, they go further in terms of magnitude. And we heard from Lagarde this morning, you know, the comment about wages being a bigger determinant of inflation. Our analysis suggests that when wages go down in Europe, and the next signpost on that is the spring negotiations in Germany, then inflation could go down. So with that in mind, we're a bit more comfortable taking the duration, the full duration view in Europe, if not in government bonds, then at least in IG credit.
But you could see then an ECB actually cutting before anyone else. That seems also like risky. Is that risky business, cutting before the Fed?
Yeah, so I mean, historically they didn't cut before the Fed. So I think my conviction on the timing of when they start is quite low. They could wait for the Fed to go and then start going. But my conviction that they can go further once they do start going, that's where my conviction is higher.
Lagarde also saying this morning that the European Central Bank will probably keep relying on bond holdings under a future policy framework that officials are due to finalize in the coming months. I mean, this is one of the other questions. All right, the Bank of Japan, I mean, probably the most interesting but also the most awkward, you know, monetary policy setting.
Yeah. Yeah, absolutely. And actually, when it comes to the equity view, you'll see that one of our highest conviction views, certainly in developed markets, is overweight on Japanese equities. I think BOJ, they're obviously, to your point, they're in the other direction to all the other DM central banks.
It's like being in the Atlantic on your own, trying to go on the other side.
Exactly, but something exciting has happened in Japan, which is that we have inflation. And that is driving a cultural shift in mindset for domestic investors. Domestic investors are starting to own more equities at the expense of cash because inflation has arrived. And that's the key story for me when I look at the Japanese equity view and why we're positive.
Is it positive all equities, or again, are you sector-based?
In Japan, we're more of a beta play. We like the market at a top-down level, so not as selective as in other developed stocks.
Karim, the UK. I mean, we spoke to the Bank of England governor a couple of weeks ago, and again, he was saying, look, it's really on a fine paper whether we're seeing a technical recession or not.
Yep.
Does it make a difference to your house view?
Not hugely, because if you look at the data this morning, yes, we are officially in a technical recession, but the devil is in the detail. You actually had no downward revisions for prior releases. There are positives if you look for them. But the BOE is in a tough spot. Obviously, they're priced to cut the least, only 3 cuts this year. I do think there's some caution to play with the gilts view there because of the term premium driver that we also have for U.S. Treasuries. But this morning is not a game changer with regards to the data.
Karim, as always, thank you so much for joining us. Karim Shadid there, the Chief Investment Strategist for BlackRock's iShares division in EMEA. Now, one pre-market stock that we need to look at, Cisco, announcing plans to cut thousands of jobs after a slowdown in corporate tech spending wiped out its sales growth. A restructuring plan will affect roughly 5% of the firm's workforce, which would mean about 4,000 jobs. The announcement accompanied a forecast that actually fell far short of what Wall Street was projecting. You can see Cisco down 5.5% in pre-market. Coming up, we'll be speaking to the Renault chief executive, Luca De Meo, after their earnings release yesterday. That conversation is up next, and this is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
So Renault shares gaining this morning as the French car maker forecasts resilient returns for 2024. It also announced plans to overhaul its lineup in a bid to counter slow demand for electric vehicles. Well, I'm very pleased to be joined now by the Chief Executive Officer of Renault. He is Luca De Meo, who joins us from near Paris. Thank you, Mr. De Meo, for joining us. You say you have a solid margin. Again, we have seen concerns about demand for electric car vehicles actually slowing. How much do you expect that to slow down by?
Look, I think that if you look at the thing long term, EV will be a dominant technology in Europe, also because of regulation, especially CAFE regulation that people tend to, forget, where you need to achieve a very low level of average fleet consumption. So we might have some bumps on the roads as we are experiencing right now, but long term, this will fly. That's for sure. We think 2024 is probably a bit tricky year, but 2025 you will see again the thing picking up because everybody will have to match the targets in 2025. So that's my view on the thing. We shouldn't doubt about the fact that EV will be a dominant technology in Europe. Maybe not the only one, okay, but it will be very, very strong, I think.
But is there anything actually that would help move the needle to try and reignite demand in the shorter term?
Look, I think it depends on I think one of the things we're doing this year is that we're introducing new cars. Normally, product offer always helps, especially because we are bringing a small car next generation EV platform. So these are cars that are much more affordable than what we've seen so far. So normally it should boost volume, at least in our case. So we think we're going to be, even in complicated times, relatively anti-cyclical from this respect. So, and then we will have to see how different governments are subsidizing. We see, for example, Germany that pulled off the thing, but on the other side, other countries are like Italy or France are investing into the thing. So all in all, I believe that we will continue to grow. In fact, in a few years, we went from 0 to 16% of EV mix in Europe. No technology has done that before in the history of automotive so fast. So we shouldn't only look at the outside of the dark side of the thing.
Yeah, talking about the half side. So you abandoned the IPO of your EV unit, Ampere. Do you think that this could once again be IPO'd, or would you change your mind in the next 2 years?
Look, right now we are focusing on trying to make sure that everything we promised on the Capital Market Day in November would be delivered, right? So cost reduction, massive cost reduction, very efficient manufacturing operation, launching the products that we want to launch, 6 or 7 cars for Ampere. So I think that's the fact that we're not busy with the IPO preparation is actually giving us a little bit more time to focus on the job that has to be done. So we're pretty cool and relaxed. At the end of the day, you've seen the results that Renault has delivered. So we have all the money we need to finance, the Ampere ramp up. So we are okay. I think we made a decision because the mood is not the right one at this moment in the markets, and I think it's very wise, cool-headed decision, and let's see what happens. The most important thing is that we can bring profitable and good cars for the customers, and we will.
When are you planning? And you will. When are you planning to sell the next tranche of Nissan shares? Does that need to be sooner because you're not IPOing Ampere?
No. I think I mean, the process started like we already sold 5% last year, and then we will look at the right moment, the right condition. We try to do it in a coordinated way with our friends and colleagues from Nissan. So the process, I cannot fix a date right now, but I can only confirm that gradually we will go down into the thing as we promised, and we did it already. So it shows that we are serious about monetizing those shares.
But we can expect something in the next couple of quarters without having a specific date. Can you give us more idea of how you think about the timeline?
Yeah, I mean, it's a kind of a sensitive information because then it gets into things that we have to share with auditors, et cetera, et cetera. So leave us, the freedom to decide when to do it based on the conditions. So, but the process started, we proved last year, and for sure there will be something, coming up relatively soon on that. But we have to coordinate with them also.
Your ambition is to create an Airbus of autos. Can you update us on speaking to some of your competitors to actually share this platform? Is Volkswagen on board?
Look, we have. I think I've always done the small cars. I like small cars. Of course, I like also big cars and sports cars and all kind of them. But I think that we've been a little bit like under investing in Europe for a number of reasons on cars that are compact that can be very useful in urban environment. So the market on what we call technically the A segment was divided by 3 in the last 15 years. I think there's no secret. If you want to lower the impact of automotive, you need to also use small cars, especially in dense urban environments. So what we're trying to do is to bring technology, a platform, and the concept of a project where we can sell a car for below 20,000 euro, an EV car for 20,000 euro and less, and make money. And there are not many initiatives like this, so this thing becomes interesting to other competitors that might want to jump on the opportunity, and we're giving that to others. So we're discussing, left and right. I cannot confirm you any, rumor on the thing, but we are very open to share, that kind of investment because it's very difficult to make money with small cars, and we're trying to find a way because it's good for the environment and good for the.
The chief executive of Stellantis also told Bloomberg that actually he's looking at pursuing possible M&A, possible consolidation with friendly automakers. Do you foresee a future where this would make sense, a merger between Renault and Stellantis?
Look, I think that we are focused on other things. We're trying to. I don't think that it is, if you want, only one recipe for success. I mean. It could be consolidation, it could be, as we are trying to do, to invest in innovation, to define and to develop a company that is more agile, more oriented to innovation, more sticking to the value chains that might grow into the future. That has been our strategy so far, and it proves to work, right? So I'm focusing on trying to move Renault into the future and make sure that Renault will more and more depend from businesses that are new businesses that have growth and structural double-digit profitability. And as I said, so far so good, and that's what we're interested in. It doesn't mean that consolidation in general could not be one way for OEMs to compete. For example, we did it. In the case of Horse, together with Geely on the ICE, let's say, technology, so in the combustion engine technology, because this is a mature technology, so it makes sense to put things together, to put efforts and assets together to find activity but on innovative things, I mean,
but Mr. De Meo,
centralization and focus.
Yeah, you're considered one of the most able managers to turn companies around. But if there's a consolidation phase, and Renault is not part of it, what happens to the company in 10 years? I mean, do you need to get bigger? Do you need to merge if competitors are merging?
But look, we are making much more money selling much less cars than used before. So it doesn't mean that being bigger makes you stronger. This is what I think, right? Of course, size in a very capital-intensive sector like automotive is a necessary condition, but I'm not sure it's sufficient right now in a time where volatility is dominating, demands, and where technology is very evolutionary. So I think that you also need that, right? And I've been hearing and practicing that kind of mantra that consolidation would be the ultimate solution for everything for 30 years. So I'm 30 years into this sector. And in fact, what you see, everybody was saying 20 years ago, 30 years ago, there would be only 3 groups, 5 groups surviving in the world.
Yeah.
And then in the meantime, you have 150 companies that emerge in China. So when you look at the list of companies operating in the sector, it's actually much longer than it used to be. So who is right? Right. So this is. I think that there is a different way of getting this.
Luca, thank you so much for joining us today. I hope to do it in person, actually, one time very soon. Luca De Meo, the Chief Executive Officer of Renault. Much more to come. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Well, Japan's economy unexpectedly slipped into recession after shrinking for a second quarter. For more, let's go to Van Ram. Van, will they succeed in bringing inflation up?
Morning, Francine. I think that, this inflation, this is not going to alter the BOJ's trajectory. They were projecting an economic growth of 1.8% in the next fiscal year. And I think they're projecting inflation to be 2.8% in the coming fiscal year as well. So net-net, I think this will still put them on the path towards policy normalization.
Okay, so interesting, Ven. Thank you so much. Ven Ram, too short a time, but you can follow everything that Ven and the team, of course, write on the Bloomberg terminal. He's from the MLive team. Coming up, we look at the UK's technical recession. That's next, and this is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
This is Bloomberg.
Well, good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. Now, this week, we've had a whole host of UK economic data and a snapshot into the current state of the country's growth. Now, prices rose less than forecast in the CPI print yesterday, while today's GDP figures showed the UK tipping into a shallow technical recession. Now, focus now turns, of course, to the Bank of England's next policy decision and the upcoming government budget on March the 6th. Now, first, to discuss today's GDP print and the steeper than expected contraction, we're joined by Sandra Horsfield, economist at Investec Bank, and Simon Kennedy, our senior executive editor for macro markets here at Bloomberg. So thank you both for joining us. Sandra, I don't know whether this makes it a little bit easier for the Bank of England, given all the expectations for cuts.
Certainly, I think there has been a lot of discussion about exactly how far they can go with rate cuts. Clearly, if we have a weak economy, that will help make the case that indeed it's not necessary to restrict the economy to the degree that we had beforehand. But we still have to take into account the labour market is a bit of a thorn in the side. If we are still looking at a tight labour market with high wage growth, the situation still isn't clear-cut, and it's not quite as an imminent prospect of rate cuts, unfortunately, as yet.
Yeah, and Simon, I mean, we've had money markets basically raise now the BOE rate cut wagers after this UK GDP myth.
Yes, it went up to 78 basis points. I think it was settled at about 76 basis points. So about 3 cuts this year, looking at an August for a start, which is way later than the May that traders were pricing in just a few weeks ago. And so certainly the concern is on the inflation side. Can that inflation come down that last mile that we've all been talking about? And certainly there's some concern that even with data such as today's that won't be happening as quickly as some had hoped.
I mean, it's tough, Sandra, if you're the Bank of England governor right now, and it was interesting in his last meeting that he wouldn't even commit to a cut the next time around, right? Is this because the situation is very unknown in terms of inflation? Is it the last mile, or is it just that it's actually not in a linear kind of trajectory?
It's very rare to get a linear trajectory. We have to be clear on that. I think the main problem is service price inflation is still too high for comfort. We're in a situation where the economy is faring quite badly, but the labour market is not. So labour productivity is not helping here to absorb the sort of wage growth that we're getting, and therefore not generate too much inflation. Treading carefully, therefore, will have to be the watchword, and I think that's what the Chancellor is trying to convey. Pay restrained, and at the same time, perhaps some reduction in profit margins, a mix of the two, I think, is what's necessary to give the comfort that low inflation will be here to stay.
And I don't know if markets were confused by the three-way split in the vote, whether it just, you know, it's the way that the MPC operates, but whether it also, in terms of communication to markets, make it that much harder.
The BOE is one of the most transparent central banks in the world. You know, you look at the Fed; it's all consensus, and they report back, and the chair can never be voted against according to tradition. Whereas in the UK, everyone gets a vote, everyone can publicise their vote, can explain their vote. To take the upside for the markets, that transparency is welcome. They can look and try and get a signal from that. But certainly when you've got 3 different votes, then that is confusing. But it underscores what we've got, which is perhaps the Bank of England, of all the major central banks, is perhaps the one that isn't as confident as others about what it's going to do next, when it's going to do it. Even with the Fed perhaps moving back away from those March bets that we saw earlier, the Fed seems a bit more consistent in its plan. The Bank of England, because in part of data, like we've seen this week, a bit more, can't be as gung-ho as perhaps the markets would like.
Does the dot plot make it easier? If they had like a Bank of England dot plot a la Fed?
It's been discussed, but if you look at the dot plot in the US, Jerome Powell and others aren't particular fans of it because they feel it in trying to be transparent, they're then held to account. And so we'd have to see. But there's obviously Ben Bernanke's looking at the Bank of England at the moment as a project. Maybe that's something he talks about and suggests for communications. But it can also paint them into a corner.
Sandra, I mean, what do you look at? I don't know if you're in favor of the dot plots or whether there's something else. Do you have like a favorite chart that you look at to give us an indication of what we're really dealing with in inflation and the economy?
I think at the moment the trends are really quite disparate if you look at goods price inflation on the one hand and service price inflation on the other. And it's about understanding the balance of the two that is particularly important right now. So that's one focus. I think for the Bank of England, maybe an alternative to dot plots, which come with their own drawbacks, as discussed, could be looking more at scenarios. How could the economy evolve in different circumstances? What are the weights of these scenarios? What's the likelihood of certain things playing out? That might be an easier way, communication-wise, for the general public than to try and explain a dot plot when that's not really the tradition. To say there are different things that could happen. We can't have that much faith in individual point forecasts. Perhaps that's an easier sell to the general public.
I mean, Simon's putting his hand forward to explain the dot plot every time there's a publication. Of course, if it were to change. What surprised you the most, Sandra, when you look at some of the expectations for the Bank of England? I don't know whether it's the fact that there's such a monetary lag with interest rates rising and how it feeds through the economy, or has the Bank of England, like many central banks, just been lucky? Is inflation coming down because of monetary policy, or just because geopolitics has gone the way they have?
It's a mix between the two. We have to be quite clear. The fact that energy markets have really shown this huge swing, and along with them, the terms of trade for the UK have improved a lot. So we have less import price pressure, less energy price pressure, and that's feeding through not just in terms of energy prices themselves, but also at input costs to other parts of inflation. So that's one clearly helpful factor. At the same time, if we do get a weaker economy and we do get weaker demand, we see some components like construction, which is the more interest rate sensitive part of the economy, slowing. So there is a bite to monetary policy, and we are starting to see it. So there is a restraining influence that we're getting as well. It's a mix of the two, so luck as well as actual actions of the Bank of England playing a part.
I mean, is it funny that actually monetary policy is lagging by so much?
Is it funny?
Well, I mean, funny, that's CFA level 5.
Well, yeah, no,
it's expecting it to have more of an impact more quickly.
Yeah, I think the big debate over lags is a huge one, both for the Bank of England, for the Fed, just when these hikes, how much they bite. We've seen lots of different reasons in labour market, for example, they haven't. Others areas they have. So yeah, it's a huge thing. Timing the market or timing the economy is going to be a huge thing for the central banks.
But AI is going to fix all of that, because productivity is going to go through the roof.
Might do so.
What do you look at, Sandra, too? So one of the debates that we have here is Bloomberg is if, for example, is it conceivable that the ECB or the BOE cut before the Fed? I mean, is it something that you spend time looking at?
That's certainly interesting, because we have had quite different experiences on one level, but also very much the same in terms of the inflation trend up and then down again until now. But if you look at some of the drivers, what's going on is a bit different. The US has had the benefit of this particularly large fiscal stimulus. Yes, Europe has had some, but it's not been on the same order of magnitude. That's an influence that's changing, and perhaps will influence when rate cuts can come onto the picture as well. We think that we could see rate cuts taking place at the same time. Still, June is our best guess for everybody at this current juncture. Of course, if the US economy were to stay super resilient as it has to date, you do have to put into question just how restrictive policy is and just how soon they could move to rate cuts. So now there's been a bit more of a wedge opening up in market pricing, Bank of England last, but the ECB actually at the forefront of rate cuts this
Sandra,
year.
what are you expecting from the budget March 6th? And could that actually, have inflationary pressures that make the Bank of England's job that much harder?
It's certainly a factor they will have to take into consideration. I think we already had an attempt at expansionary fiscal policy in the autumn statement, and certainly the political imperative is for more of the same come March. We have more messages that tax cuts, yes, are coming. At the same time, can these be huge and really game-changing? Probably not. And one of the issues is that certainly interest rates have gone up. So debt interest rate expenditure is more of a factor that will bind the Chancellor's hands. So we might not get that much by way of tax cuts. So perhaps it's not a huge influence on the Bank of England.
Great. Thank you both. Sandra Horsfield, their economist at Investec Bank, and our very own Simon Kennedy. Both stay with us for a deeper dive into the UK economy. We'll continue that conversation next, and this is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think on pay, what I would say is this. I think what we're seeing, and I would expect to continue to see, is that as headline inflation comes down, and then of course people actually have to be, understandably convinced that it's going to stay there and come further down, that feeds through into inflation expectations, and that will feed through into wage bargaining. I think we're starting to see that.
Well, that was the Bank of England Governor Andrew Bailey on headline inflation and what that means for wage expectations. Well, still with us, Sandra Horsfield, economist at Investec Bank, and Simon Kennedy, Senior Executive Editor for Macro Markets here at Bloomberg. So thank you both for sticking around. Sandra, we were talking a little bit before about, I guess, some of the pitfalls, right, that the Bank of England Governor could see because of maybe a resumption in inflation, maybe because of fiscal policy. No matter who's in charge, January 2025, there's not an infinite amount of money actually in the purse strings of Treasury. So how will that dictate the kind of growth that this country will see?
The problem that the economy is facing is that right now we're in a phase where productivity growth has been disappointing. Alongside that, GDP growth hasn't been very strong, and we're actually trying to clamp down in general in terms of migration. The argument generally is that the migration flows that have been supporting growth have been too high for political comfort. With that sort of environment, we're looking at a weaker tax take or less growth in the tax take going forward as well. And that will constrain the room for maneuver. We're already, as you indicated, at fairly high debt levels. And what is penciled in at the moment in an unspecified manner is spending restraint. That will be a drag on the economy if it comes to pass, unless we do get this much hoped for boost in productivity that certainly the government is trying to foster through its policies.
Yeah, and this is a problem for the markets at some point because the debt levels, I think Phil Aldrich wrote this great piece showing that since before COVID, debt levels have risen because of inflation and because, of course, COVID expenditure.
Yeah, and so you've got this, in theory, a supply of gilts. You're seeing it elsewhere around the world, as we've read in recent big takes. So you see the supply of gilts coming onto the market at a time where the Bank of England is also debating its position within the market. So for a gilt trade, there's a lot of things going on as they try to grope their way through the next few months of what the budget's going to be, what the Bank of England's going to do, what the gilt supply is going to be, and put that all together. It's a pretty complex job for the gilt traders out there.
But Sandra, I mean, when you talk about markets, people in corridors at IMF and others will say, I worry about a Treasury auction not going well. Should we have similar concerns for gilt auctions?
I think it is a concern for governments everywhere that we are in a situation where generally governments are still needing a lot of external funding, and to get this at a time when markets can be jittery, we've certainly had experience in the UK. We are certainly keeping an eye on this. For many years, that was something we didn't have to worry about much in terms of how auctions would go. Now it's something to watch again, and I think you never know where the issues come from, and as long as they remain dormant, everything is fine, but they can resurface. And that's something that certainly central banks are watching, but very much governments, debt departments are certainly watching too.
So the pound hitting for a fresh day low versus the dollar after that data showed that the UK economy actually fell into recession. We don't talk about sterling as much as we used to. I don't know whether it's range bound or it's just there are other concerns.
Well, there's one that Mark Cudmore was talking earlier on Bloomberg's M Live about how there's a chance the pound actually comes up either today or later in the day when people tune into the high-frequency data, the more recent activity indicators, things like the wages that we've talked about. But certainly, yeah, the pound trading down today as part of that that bet on the BOE when you see those recession headlines. And that's another thing. You see a recession headline, it kind of reinforces perhaps a mindset among the British public, among businesses, among consumers, and that has a feed-through effect. This comes back to your the lag conversation is they're trying to, Bank of England's trying to work out the market here and now or in the next few months where it's going. It's pretty cloudy at the moment, I would think.
But Sandra, again, I mean, the recession was actually not so mild. I mean, it was bigger than economists had predicted. So could we be facing a situation where inflation stays high because of a tight labor market, but actually, GDP comes down?
It is a risk. You certainly can't exclude it. At the same time, I think we have to look a little more optimistically at what is happening. Ultimately, strong wage growth at a time of falling inflation does give more purchasing power to households. And that's a factor that we think will help to pull the economy out of recession. Indeed, interest rates have started to come down in terms of market expectations. Okay, they have come back a little bit, but we're certainly a lot lower than we were. So for the more interest rate sensitive parts, such as construction, that should help the economy going forward as well. So we think we had more of a broader stagnation than really a recession in the deep sense. And going forward, perhaps we could start to see an improvement and some strengthening in growth.
Yeah, and I guess because we didn't have 2 consecutive quarters of loss, I mean, they could also be revised upwards, right? We've seen that in the past.
Oh, absolutely. I mean, initial data always need to be taken with a pinch of salt. We don't have the full set of information that goes into them, and over time, quite often revisions have tended to be on the upside. In any case, as I said, if you turn back to the labour market, there isn't a general sense that this is the sort of recession in the sense that it's defined in the US, which is a much broader context, not just the 2 consecutive negative quarters of GDP, but a downturn also in the labour market. We haven't seen anything along these lines in the numbers as yet.
Simon, when you look around the world, does the UK look fairly stable? I mean, certainly compared to, 12 months ago or 18 months ago.
It certainly looks more stable compared to then. But the point you raised about a gilt auction or a US Treasury auction, at any one time the market can turn its opinion on an economy, and so yes, certainly more stable. But I think less stable in the sense of outlook, and we've seen that with the fluctuating bets on rate cuts and questions about this upcoming budget. Andrew Bailey has actually won some plaudits lately for his communication. We didn't have quite the Powell pivot in the UK. We had more of a kind of like, well, let's await more information. And I think that's probably the right course for the central bank to feel its way.
Thank you both. 20 minutes on the economy and markets. All you ever wanted to know about the UK. Sandra Horsfield, economist at Investec, and Simon Kennedy, Bloomberg's senior executive editor for macro markets. Now, be also sure to subscribe to Bloomberg's In the City podcast that I host with David Merritt and Allegra Stratton on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. Now, coming up, German tour operator TUI is ditching its London listing to focus on Frankfurt. We discuss why it's another blow to the city's reputation. That's coming up shortly, and this is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the world world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, the global reputation of the London Stock Exchange has suffered a fresh blow. Shareholders of the tour operator TUI have approved ditching its secondary listing in the UK in favor of focusing on Frankfurt. Now, it follows a host of other listed companies shunning the city, including the gambling company Flutter and chip designer ARM. So let's bring in our UK business reporter, Sabah Mening. Sabah, thank you for joining us. You've been breaking loads of news and writing some amazing stories on this. I mean, how damaging is it that TUI's, decided to delist? It's a small part in London, but how damaging is it to the reputation of the City of London?
I think in and on itself, it's not. TUI's, as you say, not a huge company. It didn't have a big listing here in terms of market cap, but it comes on the back of a bunch of different companies that have decided to take their listing elsewhere. We saw Flutter, which pursued a dual listing in New York and is now pursuing a primary listing there. We've had CRH, there's been Ferguson, a bunch of different companies, and it just doesn't help with the kind of London as a financial centre and its sort of place in the world. And yeah, it is disappointing.
What's the problem here? I mean, I know that there are questions on whether London is competitive, for example, on executive pay.
Executive pay, I mean, liquidity is a really big one, which Peter Jackson of Flutter talked about a lot. But executive pay is another one. It may not be something people say publicly. They may not sort of outwardly say, we're definitely moving because of pay, but certainly in private discussions, whether it's sort of non-execs, whether it's CEOs themselves, even shareholders in some cases, if, particularly perhaps not for the smaller cap companies that are very UK focused, but if you're a CEO of a large global company and you've got revenues coming from all over the world and probably a very minority part of that in the UK, should you be judged globally rather than among your peers in the UK? So it's certainly a topic that comes
about valuations and whether there's a UK discount.
Yes.
Will that lead to more M&A?
I mean, even last year, which was sort of a very slow year for the city, very little M&A. We've all seen the number of IPOs. There were 40 companies that were sort of taken over last year, and the majority of those buyers were international. I think the UK is looking at a very steep discount. I mean, there's been a lot of selling by institutional shareholders, and the question is now, are they attractive to investors, or most likely to whether it's private equity, which still has dry powder, or is it international buyers that may come looking?
But you've also written about the Body Shop, and so the UK arm of the Body Shop has fallen to administration.
It has, yeah. I mean, it was bought, agreed to acquisition late last year by Aurelius, a private equity firm from Natura, the Brazilian conglomerate. And what we've seen, and they've sort of said they got the company, it was in a worse position than they thought, and they've had to appoint administrators from FRP. And it is still trading. I doubt the Body Shop will disappear, but certainly it may be in a slimmed down form, and it is another blow to the high street jobs and closures that we're likely to see.
What happened? Are there just other companies that sell products that people want to buy more, or is it the way it was managed?
I think, if you grew up in the UK, you'll remember going to the Body Shop, as a teenager, They had great products. It was one of the first to do this kind of ethical beauty, but has it really innovated as much as some of the newer brands that we've seen? People spend a lot of money on beauty and skincare, but there's a lot of online competitors, and perhaps Body Shop hasn't received the sort of the investment it needed, kind of changed. You know, people want new things. So, I mean, it will still survive, I imagine, but it definitely, it's a sad day.
It certainly is. Thank you so much for joining us. Bob Eddings there with the very latest on some of these UK companies. Now, be sure to subscribe also to Bloomberg's In the City podcast that I host alongside David Merritt and Allegra Stratton. You can find that on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. We'll be back. We'll have a full market check and, of course, looking at the latest in UK news. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Good morning from our world headquarters in New York. I'm Manus Granny.
And I'm Danny Berger. This is Bloomberg Brief. Let's set your agenda.
Former U.S. President Donald Trump is said to be considering scaling back the commitments to NATO members as he attempts to return to the White House. NATO Secretary General Jens Stoltenberg weighs in.
The commitment to defend all allies and that an attack on one ally will be regarded as an attack on all is the core of NATO. Any suggestion that we are not there to protect and defend all allies will undermine the security of all of us.
Loading up, 13F filings reveal that hedge funds bought into big tech and AI companies, including Amazon, Intel, and NVIDIA, all in the fourth quarter.
And Airbus says it will deliver fewer planes than expected in 2024. We discuss the outlook with the plane maker's CEO. A very good morning. Reclaiming the higher ground. We're going to search on the web for Steve Winwood. Higher love.
Do you want me to sing it?
No, we're not doing singing again. We know that doesn't go well on this show. Look at that. We're above 5,000, and that's critically important. 13F filings, you'd have had to have been under a rock if you didn't assume that technology was going to make it top of the agenda. Charlie Wells joins us very shortly. There's the Spurs above 5,000. Now, there are a couple of interesting stories in the underbelly. There's the transition of jobs. Cisco cutting thousands of jobs. 5% of the workforce are going to go in Cisco. So even though there is this huge migration into tech in terms of the skew, it's the #1 holding. Cisco down 5.25%. By the way, the VIX also dropped yesterday. The stocks put on over 1%. NVIDIA trumping Alphabet and Amazon. The power of that stock and the AI narrative there is colossal. Paramount also in focus. They're cutting 800 jobs on the day after the Super Bowl. But now we will get into the 13F. Michael Burry finally capitulates, one could say, and turns over on his short semiconductors position. It was via a long put option, so he didn't exactly lose the shirt. When it comes to European equities, we're up this morning. We've got a raft of reports in there from some of the drinking companies through to Stellantis. We'll catch up with the CEO a little bit later on in surveillance of Stellantis. That's the maker of Jeep and Ram here. There's a bigger buyback and a dividend. Is the chairman and the CEO in syncopation, Danny? That's the question between the chairman, who's not keen on M&A, and the CEO, who might be.
Well, they certainly have lots of cash, so that tends to help with all things M&A. I mean, it's just looking at that equity board and looking at the cross-asset. It's been a remarkably calm 24 hours. It's almost like that CPI report didn't even happen. We come in about 3 basis points on your 10-year yield. We're at 4.22% this morning. We've come back about 10 basis points after a sell-off, which saw yields go higher by 13.5. We're wiping it from our memories day by day. Meanwhile, we have a technical recession for the UK, slipping for 2 consecutive quarters for GDP growth, down by about 0.1%. For the entirety of the year, the weakest growth for the UK since 2009. That was largely expected. Perhaps what wasn't expected is that Japan is joining the Brits in a recession. Japan also falling into a recession with 2 quarters of declines. But you can see the yen is strengthening, dollar down about 0.4%. We're still above 150. The fact we're declining, Manus, might have more to do with the jawboning that we've been hearing from Japanese officials. Now, going back to this idea that we're clawing back any of those losses, both in bonds and stocks, that we saw from CPI, Mohamed El-Arian says don't ignore the CPI report and the market reaction. Writing in Bloomberg, resist the temptation to dismiss the market and media reactions as a storm in a teacup. We should see the reactions as a wake-up call for traders, investors, and economists who had embraced with too little thinking the narrative of a quasi-automatic, very soft landing that opens the door for large and early Fed rate cuts. So, Manus, don't erase your memory of the CPI in the market reaction. It might be a wake-up call that we're not getting those cuts.
No, and I think Mohamed makes a very, very clear point. I mean, Goolsbee did draw the comparison yesterday. He said, look, we focus on PCE. I think he tried to take some heat out of that perhaps exuberant response, both in the bond market at the very short end and in the equity market. So Goolsbee tried to take some heat out of it. In others, you don't need to get all the way to 2%. And it is the PCE, of course, that we focus on.
Well, Torsten Slok at Apollo would call that a policy mistake by being so dovish, because he says the last mile, it's going to be made harder by Fed speak, which seems to say cuts are coming, because that means businesses will spend, they get more confidence. So perhaps Goolsbee, I don't know, reigniting things.
Yeah, and we'll talk about Barr's comments in just a moment. But I mentioned it had to be under a rock not to work out what was going to come down the pike in the 13F filings. But of course, the hedge funds and some of the biggest tech names in the fourth quarter, they added to that position. They chased that scorching rally. The sector was fueled by the growth in AI. It's a theme we tried to say 50 different ways. 5 days a week. Charlie Wells is with us. I mean, this theme seems to be where the smart money is following AI. They were in that beautiful rush up before Christmas. So talk us through how it's playing out in hedge fund land.
Yeah, Manus, I mean, you're saying you'd have to be under a rock not to see the same. I think you'd have to be under Mount Everest not to see this rush into AI. And when we look back at these 13F filings, we see that at the end of the fourth quarter, you know, it really was these AI names that were coming out front and center. So Amazon was the biggest ad that we saw. Bloomberg has analyzed 835 of these 13F filings. $22 billion worth of shares were added by hedge funds in that fourth quarter. Other names, Intel and NVIDIA. Now, given NVIDIA's rise recently, that's going to make some investors very, very happy.
Certainly will. Reports are also giving us kind of an idea of the big names in finance. I mean, you know, we all love to see what Michael Burry did. We all love to see what Berkshire Hathaway did. Have you seen any standouts from the household name hedge fund managers?
Yeah, Danny, I mean, this is a sort of like, I know what you guys did last quarter, and we really get to see what some of these big names do. I mean, Michael Burry's Cyan Asset Management, they're known for taking some contrarian bets, and it's pretty interesting here, the way that they positioned on China. Now, we know that over the past few months, investors have really been turning away from China. Well, when we look at the fourth quarter, we see that Cyan, the top holding there is Alibaba. We see the second largest holding there is JD.com. Now, that, of course, is a contrarian bet. When you look year to date at the performance of those stocks, Alibaba down about 5% year to date, JD.com down about 20%, so that could potentially be a long-term play. But interestingly, and Manus was talking about this earlier, we even saw Burry, who is known to be so contrarian, he'd taken a bet against semiconductors. You know, at some point last quarter, we saw that he actually reversed ship there on the iShares Semiconductor ETF and is now kind of following the pack.
That's called running your profits and cutting your losses early, something that I never did, hence I ended up being a journalist. Let's talk about it, I can talk about it forever and I don't have to worry. Charlie, talk us about the indication, the direction for the markets and the economy that investors can we extrapolate anything from Michael Burry capitulating, if that's a word, on semiconductors, going long China, and some big notes have come through saying it could be time to go long China. What's your takeaway at the end of this 13F?
Manus, my hot take is AI is going to be running everything, but hedge fund managers think the American consumer is still going to be buying stuff somehow. I don't know how they're going to be earning money. But basically, we saw, you know, technology, you know, making up about 25% of these portfolios that we examined. So that's the #1 spot. But then when you look at the second spot, it's consumer discretionary. And so that's really interesting. That was coming out at a weighting of about 15% in these portfolios, which is striking, right? That seems to indicate, in some senses, that these hedge fund managers were thinking the American consumer who continues to splash out might continue to do so.
That's me. I technically fit into that box.
Why would you buy recently, Manus? Any big purchases? Yeah, so maybe you don't fit into that box. Maybe you're more frugal than you think.
I've ordered, yeah. We're not going to talk about what I've ordered. It's going to take 3 months to arrive.
And let's be honest, Charlie, when the robots take over, we're all going to be living on a beach. We won't need anything. We won't need to spend money. It's totally
right.
Yeah, it's totally fine. Charlie, thank you.
Cheers to that.
Cheers to that. Charlie, it's too early here for that. But anyway, Charlie, thank you very much. That's Bloomberg's Charlie Wells. Okay, let's turn to the banking sector now. Morgan Stanley is planning to eliminate several hundred jobs in its wealth unit. This is the first time they've done so under the new CEO, Ted Pick. Let's get over to Bloomberg's Tom Metcalf on this. Tom, I mean, wealth management is such an important part of Morgan Stanley's business. Why cut jobs in this division?
Yeah, exactly right. Look, this is the biggest unit in Morgan Stanley. It's got something like 40,000 positions there, and they're looking to cut less than 1%, but it is, I think, pretty meaningful in that this is the first time you've really seen them look to bring back maybe that wealth division a wee bit, and this is under the new CEO, Ted Pick, as you say. So for me, that's perhaps the most interesting thing is, are they seeing stuff, you know, ahead that they're just trying to sort of position themselves for? Certainly, like, the net inflows have been a bit disappointing in terms of what they've been sort of estimating for. So I think it just speaks sort of an interesting insight into maybe how Morgan Stanley is viewing this absolutely critical division for the lender.
Tom, good morning. I mean, the business model of wealth management in this country is fundamentally different to the business model that UBS, for example, traditionally used in Europe. When you look at these cuts in wealth division, is this about trying to get the cost per employee down? Have they been rising? Has there been big deals done? Is this a moment of restraint in WM here?
Yeah, no, absolutely. And, you know, it is that cost base they're really looking at. That's, you know, one of the sort of changes from Morgan Stanley. You've been hiring very heavily in recent times and are now, I guess, taking a slightly different tack. And I think, again, the background is, of course, you know, these interest rate rises are obviously starting to stop. And that was a big, big driver of profits in this unit. And so as that kind of comes off, as you'd expect, Morgan Stanley going, right, where can we kind of boost our margins? And one obvious place is personnel.
Meanwhile, over at Citi, Tom, we've gotten this drip feed of changing practices at Citi. Before it was Citi telling their sales team, maybe cut back on the drinking when you're at clients. And now we have this new one from the FT that they're going to want access to their personal phones at their wealth division for the private bankers. What do you make of it?
Yeah, I think in some ways it makes a lot of sense, right? They want to know who their private bankers are calling and just sort of have that sort of data shared among everyone, basically to help, you know, cross-sell and help find as many clients as possible. You know, there is a sense from the FT story that, you know, this is a bit of a change in that maybe they're looking a lot more closely at these kind of things. And again, I think, you know, in the broader picture of the wealth world, I think it just shows, hey, it's a bit of a harder spot for what was for many banks, like kind of the golden child for many quarters previously.
I didn't think anybody drank at lunch anymore. I mean,
how could you say such a thing?
I certainly don't. Like a nice green juice, maybe.
Technically, for Danny and I, of course, lunchtime is dinner. Correct. So there you go. Tom, I'll leave you with that thought. But we're very restrained on Bloomberg Brief. Tom Metcalf on the banks. You wouldn't go to lunch and have a glass of wine, would you?
I mean, I will on a Saturday, maybe. not on a school night, Manus. I'm more responsible than that.
She's very well behaved on this show. And let's get into some of the other top stories away from our wine proclivity on Bloomberg Brief. These are the stories that are trending on the terminal. We mentioned it at the start of the show. Cisco is set to announce plans to cut thousands of jobs. The slowdown in corporate tech spending wiping out sales growth. A restructuring plan will affect roughly 5% of the firm's workforce, which would mean 4,000 jobs. Cisco's third quarter forecast fell short of Wall Street's estimates, sending the stock lower in the pre-market trade.
Now, at least one person has been killed and 21 others injured in a shooting during a celebration of the Kansas City Chiefs Super Bowl victory. City police say 3 people are in custody, and the incident remains under investigation. The shooting happened near a Union Station, an entertainment center in Kansas City. Officials say more than 800 law enforcement personnel were on hand to handle the crowds. Manus.
A SpaceX rocket blasted off earlier today, carrying a U.S. firm spacecraft on a mission to land on the moon and end America's 50-year lull. It's called Nova C. The spacecraft, built by Houston-based Intuitive Machines, will attempt to touch down on the south side of the lunar surface on February 22nd.
Israel has pulled out of talks on securing a ceasefire with Hamas, refusing to send a delegation back to Cairo for further discussions. Prime Minister Benjamin Netanyahu again dismissed the militant group's demands as delusional. Israel's position suggests that even a temporary ceasefire remains far off as fears grow about the fate of more than 1 million Palestinian refugees sheltering in the southern city of Gaza City of Rafah, Now, coming up, we're going to talk more about geopolitics, specifically former President Trump looking at reshaping NATO if he gets a second term as he pushes for Ukraine to end the war, Manus.
And Airbus stays cautious amid the supply chain concerns. We speak to the CEO, Guillaume Fauré, later this hour. Stay tuned for that on Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
how do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
$60 billion with a B. They want to give them $60 billion more. And I said, wait a minute, do it this way. Loan them the money. If they can make it, they pay us back. If they can't make it, they don't have to pay us back. Loan them the money. Put it as a form of a loan. Why should you just hand it over to them? Do it as a form of a loan.
Former President Trump, as he pushes to end the war with Ukraine, if he returns to power. He's also considering this, scaling back commitments to NATO. Members, if he receives a second term. Joining us now is Ros Matheson to understand this. Ros, good to have you with us again. You read this story, you listen to Trump, and this is essentially either a two-tiered NATO, which would be the opposite of what Stoltenberg has said, or can I extrapolate something more malevolent from what he's saying?
Well, really, how can you have a two-tier NATO? I mean, the whole premise of NATO, when it was set up, and for decades, has been the concept of collective defense, which means an attack on any member state is an attack on all and compels them all to come in and defend the other. And so you can't have a system where you say we would come and defend some countries because they've paid their proportion of defense spending, but we wouldn't defend others. I mean, it just actually undermines the basic premise of NATO. So really what he's saying there is if he was president again of the US, if he wins the election, he might look at breaking up NATO or the US pulling out of NATO. In effect, that's what it would be. You can't do a partial NATO membership because of the fundamental tenets that underpin it. And then what does that mean if the US pulls out of NATO, not just for European security, but for global security?
2024 just feels like this world, Roz, where there are these potential hotbeds where tensions can flare up that have been simmering. And one of them certainly feels like the Korean Peninsula. North Korea had fired a 5th barrage of cruise missiles in the past month. Kim Jong-un also earlier in the month said he has a lawful right to destroy South Korea. Do we need to be focusing more attention on them, Roz? Is this another place where we could see escalation?
Well, it's interesting. It feels in a way like North Korea has gone quiet on the global stage because you've got obviously Russia's war in Ukraine, you've got the war in Gaza at the moment between Israel and Hamas, you've got concerns about China, and yet North Korea hasn't really gone quiet. In fact, they've been letting off for months and months a series of missiles, cruise missiles mostly, but demonstrating their ever-increasing sort of mastery of some of the technology of their missile systems, underwater and so on, and launches into space. And so what they're doing is they're kind of saying, please pay attention to us. We feel like we're not getting it. The question is, what does Kim Jong-un really intend to do? He's been warning and warning for months about pulling out of some of these understandings with South Korea. Is he going to get tired of not getting the attention and do something that's going to escalate to the point it demands the US attention, including nuclear weapons and testing of those? For example, it's very hard to know what he means by all of this, but either way, as you say, there's that pattern of escalation that's been going on.
Yes, and of course then there's the reaction function from the various protagonists that we've been talking about over the past couple of days. Let's talk about the Kremlin. They released a video of Vladimir Putin making his first comments on the upcoming US election.
Biden. He is the more experienced person. He is predictable. He is a politician of the old formation. But we will work with any U.S. leader who the American people have confidence in.
course, you know, that's the first that we've heard. 2016, he was a backer of Trump. Here he is, he's talking about Biden. And they are mulling nuclear weapons in space, according to US intelligence as well.
Well, that's right. It was interesting to hear his comments about Joe Biden. But if you look at the words he used, was it really an endorsement of Joe Biden? He used the words predictable, old-style politician. Really what he's saying, in essence, is that Biden is a politician that he feels he could possibly maneuver against, who's malleable, who's predictable, and that's better potentially for Russia, someone that he can perhaps feel that he can push around even, versus Donald Trump, who would be much more unpredictable potentially as president, as we've seen before. So there's that question, was he really praising Joe Biden, or was it one of those kind of underhand Putin comments that's actually an insult?
Yeah, like in a weird sort of warped way. It's
like a double entendre.
Yeah, exactly. Is it actually him saying, I support Trump, in a way of saying, I support Biden? Anyway, Roz, thank you very much for joining us. That's Bloomberg's Rosalind Matheson. Coming up, we have some earnings breakdowns for you here on Bloomberg Brief.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
We think 2024 is probably a bit tricky year, but 2025 you will see again the thing picking up because everybody will have to match targets in 2025. So that's my view on the thing. We shouldn't doubt about the fact that EV will be a dominant technology in Europe. Maybe not the only one, okay, but it will be very, very strong, I think.
Luca De Meo, the Renault CEO, speaking to Bloomberg earlier. So you had Renault earnings. We also had Stellantis earnings, Manus. It's remarkable to see them both warn about how tough of a year it's going to be for EVs. yet both share prices are up. There seems to be the consensus. If you're increasing dividends in the case of Renault, if you're giving buybacks in the case of Stellantis, maybe you got enough cash to weather the slowdown.
Yeah, I mean, I think what's going to be more interesting, actually, in Stellantis, the cash they're going to generate, and this is where Carlos Tavares, the CEO, we'll catch up with him later on. John Elkann, the chairman, came out and said, look, we're not in the market for any more M&A. Carlos, of course, doing this article, a news article a couple of weeks ago saying in the market. So this is about perhaps doing the buyback and the dividend to send a message maybe that the chairman and the CEO are in sync.
Well, you know, the rumor had been Stellantis doing a tie-up with Renault. That had been the rumor. And of course, yes, you say there's a denial there. But again, if you got this level of cash, maybe you can do it. But Tom Narayan over at RBC, who you and I have both spoken to before, basically just says, if anything, the strong cash position means that they're going to be okay. But they still have this obsession about cost reductions. It's still a problem.
And their margins did get eaten into slightly there as well. But the question is, maybe they don't buy Renault. Maybe they do a US deal.
Oh, that'd be exciting.
They've got a little bit of a US truck feature on the roster. We'll talk to the CEO a little bit later on.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
The former U.S. President, Donald Trump, is said to be considering scaling back commitments to some NATO members as he attempts to return to the White House. NATO Secretary General Jens Stoltenberg weighs in.
The commitment to defend all allies and that an attack on one ally will be regarded as an attack on all is the core of NATO. Any suggestion that we are not there to protect and defend all allies will undermine the security of all of us.
Loading up, 13F filings reveal hedge funds bought into big tech and AI companies, including Amazon, Intel, and NVIDIA in the fourth quarter.
And Airbus says it will deliver fewer planes than it expected in 2024. We discuss that and more with the plane maker's CEO in just a moment.
Manus, it's remarkable the bounce back and the calmness over the past 24 hours. After that CPI report, you'd think that we were unleashing the gates to hell, that a sell-off was imminent, but not so. This is a little dramatic, I agree.
I like a bit of drama out of you on a Thursday morning. The road to hell is paved with... You know what the road to hell is paved with?
What, my dramatic statements?
Good intentions.
Okay, here's what we got for you, Manus. 10-year yields come in by about 3 basis points. You put that together with yesterday, and we've come in by 10 basis points after the 13.5% of Tuesday. So are you out there buying those treasury dips? Meanwhile, both cable and the yen are moving in different directions, despite the fact they both fell into a recession. It was expected for the UK, but it's the most anemic growth in 2023 since 2009. The yen, though, that gets a lift. Despite the surprise recession, it gets a lift thanks to all those intervention words, Manus. 150 is where we head. Options are now moving at multi-year highs, betting on long yen, but it is the widowmaker. Will you really get there if the economy is in a recession?
It's interesting, you know, they don't want a strengthening yen in that situation. Roll it over, have a look at the equity markets. The dip buyers may have turned up in size in the bond markets. They also turned up in size in the equity markets. There are some idiosyncratic numbers to go through. Cisco down 5.4%. They're cutting 5% of the workforce. Paramount cutting jobs, 800 jobs the day after a record Super Bowl. But equities are eking out the smallest of games. We've had the 13F filings. Guess what? Everybody bought tech. There's Cisco down 5.4%. You're also seeing some other stocks on the move, along with Stellantis. There's Paramount down 4.7%, and Stellantis, of course, doing a buyback and a bigger dividend. The maker of Jeep in this country. We will catch up with the CEO a little bit later on in terms of what does he intend to do with the excess cash? Is he really not in the market for M&A? Let's pivot to Airbus, because the plane maker says it plans to deliver some 800 aircraft this year. It's exercised caution in its financial outlook as supply chain issues and woes persist. Some aircraft remain grounded because of engine glitches. The CEO of Airbus, Guillaume Folly, joins us now. Guillaume, thank you so much for being with us. You've told the market you'll deliver 800 planes this year. The market had coalesced around 826. The natural question is, are you being overly conservative with your guidance, or pragmatically conservative?
Hello, hi. Indeed, we've guided for 2024 for around 800 deliveries, coming from a guidance last year that was 720 for 2023, and we ended up slightly higher with 735. But what is important for Airbus is to be on track with the ramp-up trajectories that we have for our different planes, our different products, and in particular when it comes to the A320 family. And with what we have indicated for 2024, that's what we do. We're on track with the ramp-up to reach the rate 75 planes per month in 2026. So that's basically what matters for us. And I consider we are roughly in the ballpark of what was expected or what was to be expected in terms of ramp-up. So I consider we're on track with our ramp-up plans.
Guillaume, there still are these supply chain snarls that the entire world is considering right now. Given you are more conservative than what estimates had said, have you started to warn airlines that deliveries will be delayed for late this year and next?
Well, we're working with our airline customers based on what we tell them and not what the expectations of the markets will be on the number of planes we would be delivering. So we keep working and discussing with our customers. There's no surprise today that is linked to the fact that we're guiding at around 800 planes, because again, that's consistent with what we had in mind and what was the basis of our discussion and contracts with our customers. However, one point is important, indeed, is the supply chain. And what we're trying to achieve in this very complex environment when it comes to suppliers is the right balance between what we see coming from the demand that is very strong and the ability of the supply chain to serve our plans. So we want to be reasonably cautious in the sense of looking at those difficulties in the supply chain, understanding the bottlenecks, and making sure we find what I call the sweet spot, which is the right balance between that strong demand and that the supplier's capabilities. So that's where we are. And I hope in 2024, we'll be able to serve like what we did last year, meaning proving that that was the right balance between the two forces.
Guillaume, the supply chain is a very contentious issue. It's been brought into light by the recent disasters. Obviously, Spirit Aero is one of your suppliers. Now, whatever deals they do or whatever deals they construct, that is their responsibility if they lose money. But you as a CEO, will you now reflect perhaps on being less aggressive, less pressured in negotiating with your supply chain? Do you hold some responsibility as the CEO for the style of negotiation that you do with the supply chain?
We're in charge. At the end, we are delivering planes, in that case, to our airline and lessor customers, and we take full responsibility for what we do, what we deliver, and that comes with the management of the supply chain. Indeed, the way you manage your own supply chain is your own responsibility, but it's a rather complex thing to do in the environment we're in, especially with what happened with the COVID shock. That was really a shock for the industry, and there's a lot that is linked to a case-by-case, one-to-one discussion. There's also a question of culture at the suppliers, so you need to manage to combine those cultures, and we try to make sure that we can ramp up, that we do it focusing on the right priorities. You know that quality and safety is the top priority for this industry and for the CEO that I am, and I will keep working in this spirit.
On Monday, you called on the Boeing mishap. You said this incident makes us very humble. Guillaume, in this circumstance, what does it mean to be humble? Are you changing some of your procedures in light of what happened with Alaska Air and Boeing?
We're constantly challenging ourselves, reviewing what we do, monitoring the results of our action plans, and that's a constant evolution. So please don't believe that there is suddenly one thing happening and we have to completely change what we do. It's on the contrary, one more ingredient, one more data point that we're looking at, that we're trying to understand what it says about that supplier or that way of doing business, and there will be a lot of learnings when more information will be made available on what has happened. So quality and safety, it's a permanent challenge. It's something that I said makes us humble because we know we're exposed to mishaps, and it's on us to find the ways to have a system that works, to have people that are on top of the issues and constantly challenging and changing what we do to move forward efficiently. That's the nature of what we do.
Let's talk about taking opportunity. United are reportedly exploring ways to get out of their agreement with Boeing on some of the 737 MAX 10s. Are you in active negotiation with them? What would it take to win United over to you? Is that a real new order possibility from them on this?
I don't comment on single negotiation with one or the other of our customers. We have a very strong product line with the.
But have you seen more active engagement from have you seen active engagement from your other customers? Have you seen more active engagement, real engagement and real marketing to customers post this incident?
There are two main products in this segment. That is a very important segment for aviation. And obviously, when there are things happening and when there is an indication of more challenges coming on the one side, there are discussions with the other side.
Are you then seeing, Guillaume, more demand from those customers? Again, I know you don't want to talk about individual names, but is it a material shift?
There is a very strong demand for the A320 family. That's not new. You've seen the level of orders we had last year. It was a record year, the record year for Airbus in terms of bookings. So the very strong demand for the A320 family, and in particular the A321, was existing before this event and will continue to exist after this event. We are very happy of the strength of that product, and we keep investing in that product. We will have the entry into service of the XLR, the high-end version of this product later this year, and that's what we are doing. We are focusing on what we can do to best serve our customers.
Where's the hottest demand, Guillaume? You know, we have the West fully evolved and post-COVID travel levels are high. But if I said to you, where's the hottest order book to come from? Where would you put the pin on the map?
Obviously, in 2023, I would mention India. We had the biggest order ever coming from Indigo with 500 planes for one contract. And Indigo is a very, very important customer of Airbus. We have a very close relationship with them. We help each other during the COVID crisis, and we want to keep moving forward with them. And on top of the Indigo order was the big order for Air India with single-aisle and wide-body planes, with a total of 750 planes in 2023 for India. I think that's the place where the growth is the fastest, and that's really significant for the industry. But we had demand a bit from everywhere, including from mature markets for replacement of planes, driven mainly by the need to reduce fuel burn and to reduce carbon emissions.
Right. Yeah, it's certainly a global conversation having. So demand is still strong there. And this goes back to some of the contracts that you have with Spirit Aero, making sure that you get those things, again, as you say, in a quality manner. Of course, you're in the middle of renegotiating some of the loss-making contracts. Guillaume, how close are you to reaching a deal? And does it mean higher prices and therefore crimped margins?
No deal is closed till it is closed. And therefore, it's always difficult to say when it's finished. What is important for us is to have this close conversation and discussion with Spirit. They're an important supplier of Airbus, even if they serve mainly Boeing. They're a very big supplier of Boeing, but they contribute to our A220 and the A350 ramp-up, and that's what we are focusing on. And when we will have a set of conditions that will serve both parties in the best possible way, we'll come to contract. So I will not comment on by when we think we're going to find a different contractual set of conditions. We have a contract, or we have contracts in place, and our friends at Spirit have to comply with the contractual obligations they have agreed to sign in the past till we find new contractual conditions.
All right, Guillaume, I hope we're the first you tell when you do reach an agreement there. Guillaume, thank you so much for joining us this morning. We appreciate your time. Airbus CEO Guillaume Faury. Now, coming up, no Fed rate cuts before August. That's the view from Jay Hatfield of Infrastructure Capital Advisors. He joins us next here on Bloomberg Brief.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
I fully support what he called a careful approach to considering policy normalization given current conditions. January's report on consumer product index inflation is a reminder that the path back to 2% inflation may be a bumpy one.
It's totally clear that inflation is coming down. We've had 6-7 months in a row of the new flow rate of inflation has been very close to target or approaching the target.
That was the Fed Vice Chair for Supervision, Michael Barr, and Chicago Fed President Austin Goolsbee speaking yesterday. Goolsbee, always on the more dovish side, saying it's not CPI we care about, it's core PCE, and it's still moving in the right direction, aiding to a rally yesterday. Joining us now is Jay Hatfield, CEO of Infrastructure Capital Advisors. I mean, it is remarkable to see what happened over the past 24 hours. Stocks rally 1%, bond yields come in about 10 basis points. Jay, are you also in the camp of the dip buyers this time around?
You know, we are, although we're a little bit conflicted. So if you do, it's really just arithmetic. We use the terminal to do it. But if you look at PCE core, we're coming up with 0.5, which is horrible. And that's going to be at the end of the month. Now, we do have PPI as well. But it's fairly deterministic. It's just taking CPI and doing different weightings. Right. So that's really terrible, so you could easily be bearish. But you really already covered the bull case earlier today, talked about the UK. We've been saying for 6 months that the Eurozone was going to go into a major recession. It's actually been now it's flat and going into a minor contraction because you do have very strong exports to the US. So the domestic economy, very, very weak in Europe. And so you'd mentioned the rally yesterday. Well, a lot of US investors don't look at Europe. You just wake up and look at NVIDIA. But there was a major...
You're not wrong.
Yeah, that is the US market.
There was you can, with equities, you can safely ignore the rest of the world, which is unfortunate and arrogant, but true. But you can't ignore the worldwide bond market. So yesterday, as you noted earlier, we had very low, very negative inflation in the UK, negative 0.6 versus expectations of negative 0.3. And when we look at what we call the roll down for the Eurozone, it's going to be dramatic. So that's why we're calling for a June rate cut. We think that's nearly 100%. I noticed headlines going by in the terminal. Now, all the European officials are agreeing with what we said 6 months ago, that there is a problem.
So if it's that nihilistic in Europe, I mean, that's a fairly brutal call, and that would not be probably consensus. So it's very interesting to come in on Bloomberg Brief at 5 a.m. in New York and listen to somebody that actually knows and talks about what's happening in Europe and the UK. So if the first rate cut is in June, the market has gone from 7 to 3. Given the slowdown in the UK and in Europe, you're saying that that actually can have a material impact on policy here in the United States of America from the rates perspective.
Right, so because...
So then is it 4 rate cuts as opposed to the 3?
I think we might get to 4, but there's a horrible problem in the US in that we have this Byzantine way of calculating inflation. So we have this terrible shelter calculation.
Yep.
It's purposely delayed by 6 months. And it's delayed really by 18 because they look at renewing leases versus what we know is going on. There's this thing called the internet you can use. It's like the terminal. You look things up and you get real-time data. You don't have to go by that. And also, I don't know if you noticed, but financial services inflation went up by an annualized 30% last month. So I wish that were true, here being in the financial services industry, but that was just because AUM went up.
Yeah.
And so we could all say, oh, that's irrelevant, but that's going to go into core PCE. We're 0.5. I know that some analysts are a little bit below that.
Right.
So I don't think the Fed is going to cut until we get
but
year
Jay,
down to
this presents an
2.5.
issue because it's not even just the makeup of that data. There's been a lot of criticism about survey data, for example.
Right.
Things like JOLTS, what have you, that the surveys just aren't good. They don't have a lot of respondents. If we're supposed to be in the land of data dependency, what do you do if the data is not dependable?
Well, the Fed, unfortunately, got burned by their transitory call. So they're just going by whatever is reported as PCE. They should go in and adjust it. If you adjust, we've published data that adjusts for shelter. It would be below their target, but they're not going to do that.
So you're a natural buyer on the sort of Damocles-like days when you see bonds back up at 425, maybe even take a little bit higher. Your natural proclivity is to step in and be a value buyer of yield and also any substantial dips on these equities, because you've got 5,500 as your target for the end of the year,
right,
on the S&P 500, which is, you know, it's a 10% higher than where we are at the moment. That's quite a reasonable call.
Yeah, well, we think that's actually too low, and we'll probably upgrade that forecast when we get visibility on the Fed. We're a little bit cautious now, and we got lucky that the Eurozone data happened to come out right after our data. And, you know, you could probably play PCE core as a negative inflection, but we don't think you should overplay it. So you should buy the dips, but just be aware that this isn't just going to go to the moon. It's nice we have AI stocks that supports the market. The UK and Europe are supporting it through the bond market, but we think we'll be range bound until we get better clarity on this data. Because it could be that, because shelter is just really kind of a fantasy number, we may not get to that 2.5 until, you know, August at least. So everybody should be aware. This happened last year. You can't get ahead of things. We thought it would be super bullish. We were correct. But it took till December for the Fed to pause. So, but you shouldn't be too clever and say, oh, well, if PCE core is going to be terrible, I'll short the market, because we might power through it, particularly with all these headlines coming out in Europe that really validating our view that they are going to cut. They need to cut. They basically killed the patient. The easiest way to cure inflation is to kill the patient.
Okay.
We don't have that advantage in the U.S.
Okay, well, they killed the patient in Europe, as you said. That means we're deep in policy mistake there. Let's hope they don't make one here. That is our guest this morning on the markets with a fairly bullish call. 5,500 is conservative. Jay Hatfield of Infrastructure Capital Advisors. I'm off to surveillance. Danny can run havoc across Bloomberg Brief for the next.
We always say we're not going to break anything, but I think I just might break something if you're not here.
She's in full constructive mode.
I'll do my best. Well, Manus is going to run off to go prepare for surveillance.
We got the Stellantis CEO. So
got the Stellantis CEO, so you should definitely tune in. But in the meantime, don't leave here yet, because I've got some of the market moving events for you to watch throughout the day around Bloomberg Brief. Have fun, Manus.
Thank you.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Let's get you set up for your trading day this Thursday. Here's a look at what's ahead. First, we're going to have some economic data. Retail sales will come out at 8:30 a.m. Eastern. Is the consumer still strong? Then we're going to get Fed speak. Governor Waller will talk at 1:15 p.m. Eastern. Atlanta Fed President Bostic at 7 p.m. Eastern. And then more earnings ahead. Deere will report before the bell, plus DoorDash, DraftKings, and Coinbase all after the bell. But in the meantime, we have some other earnings that we already need to get a handle of. More tech job cuts. Cisco will slash 4,000 jobs. That's about 5% of their workforce. Before this, tech layoffs had already totaled 32,000 for 2024. So you can add another 4,000 to that amount. Paramount, same story. They're also cutting jobs. 800 jobs to boost profitability. Berkshire Hathaway also reducing their stake. Stellantis, that is up. A CEO interview coming shortly.
Faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
If you look at the Fed, they've been talking about patience, the need for more time, the need for more data.
We still think the Fed will begin cutting late this spring or in the summer. But again, it's just not going to be a straight line.
We think that the Fed is probably going to be on hold here at least until June.
What we're looking at going forward is higher for longer rates, less rate cuts than the market expects.
There's quite a bit more data to come before you get to that June FOMC meeting.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
I've been practicing this. Good morning. No, I can't do it. That's his thing. From New York City for audience worldwide. Good morning. Bienvenidos. This is Bloomberg Surveillance alongside Anne-Marie Hordern and Menace Cranny. I'm Lisa Abramowitz. Jonathan Farrow is not here. As you've noticed, I am not him. He is on a well-deserved couple of days off, but we're returning with us next week. I have to say, I want to kick off with a market that is Teflon. It seems like nothing seems to bother it for a hot second. We had some inflation concerns. Then those were a dip that was buyable. Menace, what do you make of the fact that nothing seems to matter in this market?
It is Teflon. It's almost as if the entire equity market has gone to Ibiza in January and just started partying already. I mean, it's just unbelievable. The past 48 hours, we've gone from rock hot CPI, which Paul Donovan said was hashtag hot, and then we got hashtag hysterical. It just doesn't seem to touch the sides, does it?
Well, okay, so yesterday we had a really sizable rebound as people shook off this feeling that maybe we'd get some sort of resurgence in inflation after a CPI data that came in hotter than expected. We heard from Austin Goolsbee. Basically, we're looking at PCE. We're not even looking at CPI. There seems to be a complacency. Are we starting to see cracks, though, Menace, under the hood when you start to look at some of these auto manufacturers and others starting to talk about margin compression, starting to talk about layoffs, starting to talk about a little bit more uncertainty?
Well, I think if you look at some of the reporting numbers that have come through in the past 24 hours, 48 hours, it is about margin, especially for the bigger plane makers, along with the automakers. We'll talk about that in a moment. But go back to what Mohamed Al-Arian's op-ed is about. He said, it is a folly to completely ignore the CPI data. It's just almost an infantile, sort of attitude to take towards the data. It has got relevance at some level, and that's Mohamed Al-Arian, not me.
Infantile. That's a way that people like to describe. Very well done. I'm wondering, Anne-Marie, we are hearing from the administration, we are hearing from Janet Yellen, who doesn't think it's infantile to look past CPI, who thinks that probably you should look at the progress. It's going to be bumpy, but this is exactly what you're kind of going to expect.
And they're going to keep going back to the fact that wages have kept up with inflation, although we should know that real wages are actually lower than when Biden took office, so something that could potentially hurt them. Yesterday, she spoke to CBS and she said Americans should feel confident that inflation will come down to levels that will no longer really be noticeable or worrisome to them. The issue, though, right now, though, if you look at the polls, inflation is still bothering consumers. Which is why I'm so interested about retail sales today. Does that health of the consumer continue?
Yeah, well, this is what we're going to be watching heading into a retail sales, given the fact that we do get that at 8:30 a.m. as well as initial jobless claims. The expectation is for it to come in again at a pretty low number of 220,000. Coming up this hour, we do have Julian Emanuel of Evercore with U.S. stocks bouncing back from the CPI surprise. Wendy Schiller of Brown University as GOP frontrunner Donald Trump doubles down on his criticism of NATO. And Gilles Moek of AXA Investment Managers as the UK and Japan dip into recession, even though people don't seem to be paying attention to it. We begin with our top story, U.S. stocks looking to gain back losses from this week's hot inflation print. Julian Emanuel of Evercore ISA, not surprised, saying, quote, the reaction to CPI was FOMO turned to fear, typical when data disappoints in a momentum market. The good news is cuts are now appropriately priced given the potential for an economic slowdown in late 2024. Julian Emanuel joins us now. Congratulations. You have the prize of the week saying Goldilocks gets a gut punch, which I absolutely loved yesterday. Why does nothing seem to matter?
This is a truly extraordinary environment because nothing seems to matter on a lot of fronts. And frankly, when you come down to it, this is still an economy, a market that is actually still working off, despite 2 years of record tightening, the extraordinary stimulus. We just don't appreciate, and maybe we're starting to appreciate, how extraordinary the amount of stimulus that was put into the economy in 2020, 2021, and the Fed was actually still buying bonds to start 2022. And that has gone much longer than people would have thought. And frankly, you're now at this point where a lot of the data is counterintuitive to a market that keeps rising, and so you've gotten emotional. And now we're in this chase. We haven't had these kind of conversations with clients since 2021.
Okay, I'm getting a little bit emotional. You're talking about how, yes, there are all these extreme yet not irrational valuations, but the headwinds to Goldilocks are there. How difficult is it for you to convince people of this, given the fact that people can look past it and see a lot of gains with respect to earnings, particularly with the leaders in this market?
It's very trying, but again, what you're seeing, especially from day to day, and you see it in the small cap indices is one of these areas, up 2, down 4, up 2, and again this morning, leading lots and lots of cognitive dissonance, and frankly, this is a point in time where people are paying more attention, as they perhaps should, given the last couple of years, to the price action rather than the fundamentals. We think there'll likely be a time where the fundamentals do sort of take a front and center stage that says, okay, let's pause here, let's digest the gains, but we're not there yet.
So if we've got to have a moment of pause, if you look at the 13F filings, I know they are historical and they're from before Christmas, but you see people like Michael Burry, I would say capitulating, or just honestly saying, look, I had a big put option on semiconductors, and you know what, I was wrong. So he's cut his losses. I use the word capitulate, but do you think we're going to see more of that, or do you think that that has run its course, those kind of moves where people throw in the towel on possibly being short of this market and trying to fight against it, and they just go, look, this is a rising wave, I can't afford to be out of this?
Well, so if you look at the past, and the past is, not always exact, but instructive. You got to 28 times earnings at the top of the bubble in Y2K. Mm-hmm. You're at 22 times now. Our work says that on a one-year forward basis, your expected historical return is 0. That having been said, you're at a time where, again, we'll probably get a better look on the degree of capitulation next Wednesday, when the stock that is the market right now, and we all know what that is.
Do you want a drum roll?
Exactly.
It's NVIDIA.
Exactly.
NVIDIA we trust.
Reports earnings, and you look at the move in those shares, up 45% year to date, and that company could go 20% either way next week.
You actually think on reporting day they could swing by as much as 20%? But it's going to have a much more pervasive and wider influence, though, apart from just its own movement in of itself, isn't it?
It absolutely has, and it has in the last several quarters. In fact, if you go back to the May quarter, where there was the original, oh my goodness, this company can actually report earnings that we've never seen before, it catalyzed an entire market run-up from May into the July peak.
You've been talking about being defensively positioned, and you're talking about being defensively positioned in stocks. Is it also having a larger than sort of average portfolio of bonds at a time, where people are concerned about inflation, people are concerned about the Fed, but not concerned about a downturn?
And they're not concerned about the inverted yield curve either, Lisa. So when we talk about bonds, we're just as happy to be in cash right now, because again, part of the narrative around bonds that we've seen the last several weeks is yes, Japan's falling into recession. Yes, we learned the UK is falling into recession this morning, but the Atlanta Fed GDP is 3.4%. And in that environment, you'll clip your coupon and you'll probably get some capital appreciation if the economy slows, as we think it does, towards the end of the year. But, at 5%, cash is not too bad either.
Do people throw straws at you when you walk into a room and start telling them, just sell everything, go into cash, and go into defensively positioned stocks?
So here's the rub, is that, first of all, that's never an option, okay? Because let's go back 40 years. You don't time the market in that respect, because when you do, you sell your stocks in March of 2020 and you don't hold on for the next 4 years. So we don't think that way. But there is a way to do it rationally. And when we look, and this is part of what the conundrum of this year is strong U.S. economy. Mm-hmm. What sectors are underperforming the S&P 500 this year? Consumer discretionary industrials, materials, and energy. Go figure.
Well, does that say to you, just, I was going to talk about Japan, but you've curveballed that. Those underperformers, what does that say about the silent recession that many people say to me is having? It's not a huge job-cutting recession. We're coming to the end of savings. We're coming to the end of COVID money. With those kind of underperformers, what does that say about the underbelly of the economy?
So that message is not yet clear, but the concept of that message not being clear is the flip side. Okay. Is what it says is everyone's buying technology, communication services, which is actually, in our view, has a lot of defensive properties, and we like that sector. And strangely enough, healthcare. It's that kind of environment, but you need to stay invested, but you can also have an eye towards defense as well, the cash flow.
How much can the U.S. continue to grow, though, when you wake up in the morning and Japan's in recession, the U.K.'s in a recession? At some point, will something stop U.S. exceptionalism?
So, in theory, that should be the case, but this is one of these cycles that we all thought coming out of the pandemic, there would be this element of synchronization for several years on end. And obviously, if nothing else, China really interrupted that calculus by staying in COVID zero for too long. And that is part of the story. The thing about the U.S. economy is it's much more insulated and self-contained than the rest of the world, on the order of 70 to 75%. So it's one of those. It can go on until it doesn't. And frankly, the most important economic number is the every Thursday at 8:30 jobless claims number. Okay, that is on the ground, real-time data, the health of the economy. We haven't started to crack yet at all.
So we are 2 hours and about 20 minutes away from the most important indicator of the week, of all indicators that we might potentially get. What is sort of the tradability of this number and retail sales, which is another read on the health of the U.S. consumer?
Well, the clear implication of what we've seen in the last few days is don't trade the numbers, okay? Because if you traded CPI and you didn't have any time to sell or short the market, and if you went and did that after the number, you're already far underwater given the bounce back we had yesterday. This is, again, one of these times where you have to think about your risk reward and know that there's a difference between the institutional investor, whose own risk is probably greater missing the upside, versus the retail investor, who should probably be thinking, as we encourage at times, how do I feel here? Do I feel a little bit greedy? If I do, let's reconsider, let's trim a little bit, and let's make sure that, and thinking about the last 40 years, you make money by buying pullbacks. That is the way. And if you think that you're going to be a seller down 10 or 15%, you should be trimming your holdings now.
Julian, always wonderful to speak with you. Julian, you're sticking with us. We'll ask, are you feeling greedy? Julian Emanuel of Evercore. Right now, let's get you an update on stories elsewhere this morning. Here's a Bloomberg brief with Yahira Hakez.
Hi, Lisa. Celebration turned into chaos in Kansas City. At least one person is dead and more than 20 others wounded in a mass shooting during the Kansas Chiefs Super Bowl victory parade yesterday. Authorities say at least 8 of the victims are children. 3 suspects are in custody. Mayor Quinton Lucas says the White House and federal agencies have offered assistance, while President Biden renewed his call for an assault weapons ban. Morgan Stanley is planning to cut several hundred jobs in its wealth management business. It would affect less than 1% of employees in the group of about 40,000 workers. The cuts will be the first under new CEO Ted Pick, who took the helm in January. Morgan Stanley cut more than 3,000 jobs last year as the bank looked to reduce expenses amid a drought in deal-making. For the second time this year, a U.S. company will try to put a spacecraft on the moon. The Nova C moon lander, built by Houston-based Intuitive Machines, took off this morning on a SpaceX rocket from the Kennedy Space Center. It will attempt to land on the moon in about a week. If successful, it will be the first privately built lander on the lunar surface. And that's your Bloomberg Brief. Lisa?
Yahira, thank you so much. Up next, Ukraine aid facing an uphill battle.
60 billion with a B. They want to give them 60 billion more. And I said, wait a minute, do it this way. Loan them the money. If they can make it, they pay us back.
That's coming up next. You're watching Bloomberg Surveillance.
the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Drumbeat to retail sales and jobless claims. Good morning. This is Bloomberg Surveillance alongside Anne-Marie Hordern, as well as Manus Crenny this morning. John Farrow on a well-deserved few days off. He will be returning next week. Right now, we are seeing markets with another lift after an incredible retracement yesterday. Stocks futures going still above 5,000 after clawing back some of the losses made on fears of inflation. What inflation? 5,024 on the S&P, up about 0.1%. Euro gaining versus the dollar, just slightly up 0.1, 107.36, even with some weaker than expected data out of Europe. We'll go into that in just a bit. The 10-year yield down just slightly again. That retracement, 422 right now on the yield at a time when people are expecting the Fed to still cut, even if inflation is a bumpy road lower. And of course, crude a little bit lower as we talk about maybe an oversupply. We'll get more into that later on. Under surveillance this morning, Ukraine aid facing an uphill battle.
60 billion with a B. They want to give them 60 billion more. And I said, wait a minute, do it this way. Loan them the money. If they can make it, they pay us back. If they can't make it, they don't have to pay us back. Loan them the money. Put it as a form of a loan. Why should you just hand it over to them? Do it as a form of a loan.
Here's the latest. NATO defense ministers are meeting today with U.S. efforts to further assist Ukraine deadlocked in Congress. Donald Trump doubling down on his criticism of NATO. Bloomberg reporting that Trump may scale back NATO commitments and push Ukraine to negotiate with Russia if elected. Randy Schiller, director of the Taubman Center for American Politics and Policy at Brown University, joins us now. You know, I gotta be honest with you. At a certain point, I can't parse out the noise from the signal. How much are you looking at this, Wendy, and saying that there's something behind here other than just bluster?
Well, no, I mean, Trump is trying to remind people that he was president of the United States. He did deal with world leaders. He does have a position or a philosophy, which is that you don't spend U.S. money on conflicts abroad when there's no direct U.S. interest. And he has said repeatedly that Russia's not our enemy and this is not our war. And he is tapping into a strong vein in the American public of avoiding, you know, deep military conflict or deep military assistance to foreign lands. I mean, not just U.S. troops, but clearly U.S. money. And when his base is thinking that they're falling behind and they're not getting things from the U.S. government domestically, it's a powerful argument to say we shouldn't be sending $60 billion in aid abroad. I mean, the whole idea of this aid, though, that it's money, it's actually weapons. It's U.S. money putting back into the U.S. industrial complex, and then old weapons will go to Ukraine. But when he talks about a loan for Ukraine, how much is that putting pressure on Republicans in Congress to just continue this paralysis when it comes to the foreign aid bill? Well, I think he's putting tremendous pressure. You've seen yet another Republican member of the House, who's chair of the oversight, the Homeland Security Committee, say he will not run for re-election in a pretty safe seat. You know, you're having almost a record number of members of the House, Democrat and Republican, walking away from the House of Representatives. And the Republicans who are walking away don't want to face a Trump onslaught. They don't want to have to do Trump's bidding, not only now, but if he wins for the next 2 to 4 years. So you're seeing a reverse Trump effect on the actual infrastructure of the Republican Party in the House. And you're right, the Biden administration has done bad messaging on Ukraine in the sense of explaining what those dollars actually buy and that they support the U.S. economy through the defense industry. We woke up this morning to new comments from Vladimir Putin talking about President Biden. He says to Russia State TV, quote, he's a more experienced person, he's predictable, he's an old-style politician. What do you make of this? Who do these comments actually help when it comes to the race in November?
Well, I mean, it's an interesting sort of muted, attack, if you will, on Biden. And, obviously the Trump-Putin connection, Trump has said favorable things about Putin, and it has not hurt him among his base. I think the Russians technically want to stay out of 2024. I think they'd prefer to see Trump come in. And I think they're testing the messaging in the American public of making Russia the enemy. Is it still working for Biden? Is it still working for the Democrats? And that's what they're doing by sending out cased in reasonable language, but certainly trying to dig at Biden and seeing if that plays in the American voting public.
Well, it's only a backhanded kind of slap, isn't it? He's a more experienced, he's predictable, he's an old-style politician. So let's see where that discussion goes. I want to get your take on this bifurcation proposition that Trump puts on the table about NATO. How concerned? We heard from Stoltenberg talking very clearly, attack on one is an attack on all. But for the NATO allies, this is a very clear indication, the road of travel, that if Trump arrives in the White House, the real risk is that the U.S. pulls out of NATO, or is that just extrapolating too far?
I don't think President Trump will pull directly out of NATO if he's president in 2025. But there is a pattern. He pulled out of the Iran deal, which is multilateral. He pulled out of the Paris Accords on environment, multilateral. He is not a multilateralist. And he will not support sending lots of money to support the North Atlantic Treaty Organization, which is something created out of World War II, because its poise or its mission was really to thwart Russia. So I think there is something there, but I don't think that he would feel supported in pulling us completely out of it or not coming to their aid when he looks at the polls. And he doesn't technically have the right to run for re-election again. So that's another thing to think about Trump. What does he want to do in 4 years? Because this will be it for him, the 4 years in office, if he believes that. So these are the kinds of things the Europeans and NATO allies have to calculate. But I think he likes generals. He typically listens to generals. So I think that there will be a huge push against complete withdrawal from NATO.
As a political historian, Wendy, does it frustrate you that with all of the calls on the Democratic side for Joe Biden to consider somebody who is younger and newer and fresher to the political scene, that there has been no movement on that front?
Well, as I've said before on this show, I do think that Joe Biden will run if he's healthy enough to run in his own mind. He has time, actually, and he is the leader of the free world. He is the leader of what is now the most vibrant economy, or close to the most vibrant economy on the planet. And he doesn't think that anybody else in the wings can beat Donald Trump. Now, at the convention, which is a long time from now, if there's a real push, they can nominate somebody else. Party conventions used to actually select our presidential nominee. So there is a way for the Democrats to do this if he's really tanking in the summer. Clearly, his allies in the White House, obviously his staff people, and he himself does not believe that he will be tanking come summer. He's waiting for Donald Trump to trip himself up in more public appearances. That's been the pattern in the last 6 weeks. And, ask us in April or June. I think that would be the Biden response in terms of how they match up with Donald Trump.
We'll ask you in April or June, hopefully before then. Wendy Schiller of Brown University, thank you so much for being with us. Still with us, I'm so glad to say, is Julian Emanuel of Evercore. And I have to say, Julian, all of these people who come on say the market's not going to go down in an election year. The Fed's not going to hike rates in an election year, including you, despite some of the concerns or talk recently that maybe they need to combat inflation. How do you factor in the silly season of elections into some sort of thesis?
Well, let's decompose that. The Fed is not going to hike rates in an election year. And that's part of why the market rebounded yesterday. Because when that CPI number came out, we had a number of people say the reflex reaction is, oh, the next move's a hike. No way. Not happening in front of the election. And Goolsbee actually came out on camera to more or less remind people that's the case yesterday. Look, this is an incredibly complex environment. I don't think I need to tell that to anyone. It is no great surprise. But when you think about politics, the temptation would be to say, yeah, it's an election year. Yeah, they're stimulating, and that is good for the market, and that has proven to be the case so far. But our work says that this is an extraordinary election year. The control of Congress, as we've seen by the incredible focus on an election out on Long Island that, you know, normally no one would really care about. But when the House has 10 or fewer seats in the balance of power and the Senate 2 or fewer, that means volatility this year, and that's what we're going to get.
All right, that's what people keep saying, buckle up, and we're sitting here waiting, and the buckle seems to only matter because it just keeps going up. Julian Emanuel of Evercore, thank you so much. It is always wonderful to have you, a wonderful friend of the show. Coming up, Airbus shares falling after the company announced disappointing guidance amid supply chain issues. It's evidently not just Boeing.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Until the most important data of the week. As always, we get initial jobless claims. We also get retail sales, a look at the U.S. consumer that has powered a rally that has defied almost all expectations. Let's take a look at that rally, getting a little bit more added to it, up 0.1% in the U.S. S&P futures, 50.24 after crossing that 5,000 line again yesterday. Basically, CPI hotter than expected. Did we really care about that? NASDAQ futures up about the same amount. Russell 2000, and this is one I've been watching, Manus, the idea that that it sold off dramatically in the wake of the expectation that maybe the Fed would have to hold rates higher for longer. And then yesterday, retracing with a bang. How much is this sort of the trade that is the way to play rate expectations and interest rate fears, and frankly, the first place people go when it's risk on?
Yeah, I mean, if you think Goolsbee came out and really his comments yesterday, I think, took some heat out of the CPI. He was wheeled out yesterday saying, look, stop getting hysterical over this CPI print. Focus on what you've been known to focus on, and we focus on, which is the PCE. And we don't have to make it all the way to 2%, basically, to begin the cutting cycle. And I think one of the interesting conversations I've had this morning on Bloomberg Brief, which was the slowdown in Japan, the slowdown in the UK, and the slowdown in Europe is more malevolent from an interest rate perspective, not an equity market perspective. I know the two of you would cry at me and go, heresy, that the world, US equities can survive without anything from the rest of the world. I get it. But from a rates perspective, the ECB and Japan are going to be in a different trajectory now because their economies are so under pressure.
Which is the reason why perhaps people are piling in. We'll get there in just a second. In the U.S., the rate sphere is basically tempered after you got some of the comments from Austin Goolsbee, who, as you just heard Manna say, was wheeled out. I'm not sure that it was particularly orchestrated. We're seeing a bit lower, no drama, yields for 22%. The two-year yield down from as high as 460, 456, as people really try to figure out whether the Fed will still cut rates. It seems as if they're still on that path. And then if you take a look at that differential that Manus was just talking about, this idea of weakness over in Europe, over in Japan, and if you bring that through the currency exchange, what's interesting here is this idea that not as many rate cuts could actually bolster the euro regional. We did hear from Christine Lagarde coming out and saying it's premature to cut, still trying to sound hawkish as they try to get inflation under control, under surveillance this morning. Let's get to one of the topics that just doesn't seem to go away. Israel will not send delegates to Cairo for talks aimed at securing a pause in fighting with Hamas. Prime Minister Benjamin Netanyahu is calling demands from the militant group delusional. Hamas is demanding a total withdrawal of Israeli troops in Gaza in return for the release of hostages. Meanwhile, Israeli forces are preparing an assault on the southern Gaza city of Rafah, where it says Hamas firefighters do remain. Anne-Marie, I have to say, I don't really understand the back and forth behind these stories. I don't understand where the U.S. influence is. I don't understand, does this mean that we're not going to get some sort of ceasefire, or that we're making progress and this is part of the whole negotiation?
Two things I think we need to remember this morning. According to Israeli press, there's a lot of pressure on Netanyahu to send a delegation for those talks earlier in the week in Cairo with the head of Mossad and Director Burns of the CIA. So to say that Israel's not going to go to the second one, I'm not surprised if they were really reluctant to go to the first meeting. Second, we have to remember the New York Times just the last hour is reporting that Israeli troops have actually entered a medical complex in Gaza already, in southern Gaza. So what the Israeli military is saying in their statement is that they are conducting a precise and limited operation inside Nasser, this medical complex in southern Gaza, but this is going to draw a lot more condemnation from a lot of individuals around the world who are saying enough is enough, given the death toll of Palestinians.
Do we have a sense of whether President Biden's policy toward Israel is shifting at all, or if there's just sort of a shift in rhetoric recently?
Well, you've seen a lot of those reports about what he's calling Benjamin Netanyahu behind the scenes. This administration is definitely frustrated. You've also seen a lot of Democrats in Congress say that they don't want to send more aid to Israel without strings attached. Now, that aid bill, obviously, we know is still shuffling around. We potentially not sure when that's going to actually see the light of day for a signature from the president. But the fact of the matter is, you do see Democrats starting to definitely take a shift. And there's a tremendous amount of pressure on Biden to really try to get Israel to what he said. He said it was over the top. So
well, he's actually called for a credible plan. He had the meeting with the King of Jordan just the other day, and that was the first face-to-face meeting of the King of Jordan with Joe Biden, where Joe Biden said that we need a credible plan for more than 1 million people sheltering. And the King of Jordan goes on to talk about the catastrophe, the certain to produce a humanitarian catastrophe if this scales up the way that it's presumed to do.
Well, on a lighter topic, to not to shift gears, but hedge funds are helping to fuel the rally in big tech and AI. It's a hard pivot, didn't really make it well. According to the quarterly 13F reports with the SEC, Amazon, Intel, and NVIDIA were among the top targets from investors. The rush helping NVIDIA rocket to the third largest U.S. company by market cap. Just this week, the chipmaker has surpassed both Amazon and Alphabet. It's now its own country, the country of NVIDIA. I have to say, when I look at 13F filings, Manus, do I care about them? They're looking at a moment in time at the end of a quarter that happened a year ago, not really, but it feels like it. And it doesn't really take into effect short positions. Does it tell us at least that they're playing in the big guys like everybody else?
Look, I always think we like to look through the window. It's a bit like that sweeping shot that you have coming in here. It's coming in through the window and looking, look, what is Michael Burry doing? He's capitulating in theory. It gives you an insight into emotion. And I think Julian Emmanuel just summed it up beautifully. He said next week he thought NVIDIA could move, the stock that he can't name, could move by 10, 15, 20% on their reporting day. And that, Lisa, is the more prescient move. But it is fascinating when you see that still, I mean, you'd have to be living under a rock not to realize that tech was sort of widely scooped up in the run-up to Christmas.
So it's good for storytelling, which it is.
Yes.
It's just a question.
It makes Bloomberg surveillance fill 1.5 minutes on 13F filings. Go on.
All right, let's talk about storytelling. More Fed speak, a different kind of storytelling on deck with Waller and Bostic set to speak today. Comments from Presidents Barkin, Daly, and Vice Chair for Supervision Michael Barr. Rounding up the week, investors looking to retail sales and jobless claims about 2 hours from now. It is very important. We also get U.S. PPI and the University of Michigan Consumer Sentiment Survey due tomorrow. To me, this is the conundrum. You either have good economic data that then leads to inflationary pressures, or you start to get a slowdown that creates some sort of pressure on both the political sphere, but also potentially that's enough to bring down inflation. Did we hear any acknowledgement yesterday, Anne-Marie, from Janet Yellen, about this difficult moment and how it's been difficult to message and it's been difficult to forecast?
Well, the administration will continuously say there's still more to do, especially when it comes to inflation. So they're going to want to tout some of their victories. Look where we started, look where we are now, but there's still more to do. And they understand that this is hitting, especially when you look at the recent inflation report. These are food prices going up, some energy bills when it comes to electricity going up, insurance going up, daycare going up. They understand that it's hard for the everyday American consumer, but they will point to you with the Michigan survey coming out. They're going to say people actually are starting to feel better about the economy. But will that remain the same if inflation continues and if it stays hot?
Yeah, well, this is going to be a key question, especially given some of the stimulus that evidently keeps people's bank accounts full. Meanwhile, it is not just Boeing. Airbus striking a cautious tone. The plane maker saying they expect to deliver a lower than expected 800 planes this year due to, you got it, supply chain issues that are continuing. CEO Gayami Fari speaking on Bloomberg Brief earlier today with the one and only Menace Cranny.
We've guided for 2024 for around 800 deliveries, coming from a guidance last year that was 720. We're on track with a ramp-up to reach the rate 75 planes per month in 2026. So that's basically what matters for us. And I consider we are roughly in the ballpark of what was expected or what was to be expected in terms of ramp-up. So I consider we're on track with our ramp-up plans.
For more, George Ferguson of Bloomberg Intelligence joins us now. So it's not just Boeing. Are Airbus's issues on par with the same that we've just been lambasting over in their American counterpart?
Well, I mean, they're not, right, because they're not having the quality issues. And I think that's probably pretty important for Airbus here, right? The ramp up actually was a little better than we expected, that I'm sure there were some more exuberant people on the street that thought they could go even higher. But I think they're really trying to control quality here, make sure their manufacturing facilities are performing correctly. And so they're, probably going to hold back the increases a little bit. And it's going to cap their ability to take market share from Boeing. Maybe the market's a little disappointed about that, but it's a very intertwined supply chain in this industry, and so if one company's having problems with it, it's a good bet usually at the other manufacturers too.
George, good morning. How important or how credible is the argument that now is the moment when Fauré can really make hay at Boeing's expense? He wouldn't answer. United are in the process, we understand, of renegotiating with Boeing. I mean, this is a classic moment of where you go on an aggressive marketing campaign, sales campaign, to win additional market share. A, do they have the capacity to deliver on those any new wins that they get? And B, will they get a tailwind, excuse the pun, from the debacle on the other side?
I mean, I think United's a very good case in point, right there. You want to win those good core customers. You want to keep them for a long period of time. You want airlines that are going to buy a lot of airplanes, and that just makes it really harder to get wins here, right? Because you got to go find a lot of capacity for airplanes, and those airlines want it in the near term, not in the long term, right? So that narrow body backlog right now is 7+ years long. If they tell United they want to conquest them, bring them over to the A321, they can't tell them they can get them airplanes in 5 years. And you can't move the supply chain that quickly in this business. You can't, it's already stressed. You can't work it that hard to get, I don't know, 100, 150 airplanes for United in the next 2, 3, 4 years. It's really hard in this business, I think, you know, especially where we are now with backlogs, to go out and conquest a lot just because Boeing's having a problem. It's one of the saving graces for Boeing right now.
Do the Boeing and the Airbus CEO have responsibility? And again, I tried to push them on this. Do they have a responsibility? They were aggressive negotiators with their supply chain, and that was in the pursuit of profit and margin. That is ultimately the objective, to deliver equity shareholder return, which is about delivering margins. And in a certain extent, the CEOs of these airline companies have got to take responsibility for the negotiation practices with the supply chain. Will it change?
I think it has to, right? I think what you're seeing is Boeing already changed part of it when they went to Spirit Aerosystems, adjusted some of the reimbursement for the aircraft, especially 737 and 787, and we saw better results out of Spirit, you know, this quarter. I understand right now that Airbus is in the middle of those negotiations as well. At Spirit, I would expect that could help Spirit's results. At Raytheon RTX, the Pratt & Whitney issue, I think the engine makers have more power. So I think that's less on the manufacturers and their negotiation for better margins, and more on RTX management and their and what they've done to you know, accomplish the plan.
George Ferguson of Bloomberg Intelligence, thank you so much for catching up with us. Let's catch up with other stories in the world this morning. Let's get over to the Bloomberg Brief with Yahaira Hakis. Yahaira.
Hi, Lisa. Bitcoin is once again leading the crypto market higher, climbing past 52,000. The move is part of a broader rally that also sent Ether back above where it was before the Terra USD stablecoin collapse 2 years ago. Bitcoin has surged 22% year to date, pushing its market cap above $1 trillion for the first time since December 2021. Cryptocurrencies have been gaining momentum thanks to the debut of Bitcoin ETFs. Cisco shares are falling in the pre-market after the largest maker of networking equipment slashed its full-year forecast. It also said it would cut about 5% of its global workforce. That's about 4,000 jobs. The restructuring will cost about $500 million. Cisco is grappling with a slowdown in corporate tech spending as companies worry about the state of the economy. NVIDIA's scorching rally continues, with the chip maker surpassing Alphabet's market value. It comes just one day after the company overtook Amazon's market cap. The chip giant is up 49% this year, with the company now worth $1.83 trillion, making it the world's fourth most valuable after Microsoft, Apple, and Saudi Aramco. That's your Bloomberg Brief. Lisa?
Yahaira, thank you so much. Up next, the UK is sliding into recession.
I think the big change is that we've moved from how restrictive do we have to make policy to get back to target sustainably, to for how long do we have to maintain this stance of policy to achieve that.
That's next. You're watching Bloomberg Surveillance.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
5 weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Building on gains, welcome back. This is Bloomberg Surveillance. Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. John is off today. Anne-Marie Hordern is in, and so is Manus Cranny, which we're so pleased to say, coming from the Bloomberg Brief, dropping by our set as markets continue to climb. Why not buy if you can? That seems to be where people are at. S&P futures up about 0.1%, just sort of continuing rising above that 5,000 mark. Euro gaining just a touch versus the dollar. A question of policy response after weaker than expected in the data from that area, 107.37. 10-year yields off just about 3 basis points, but really markedly higher after that CPI print that came in hotter than expected and crude lower. And this, to me, is a really interesting story. Anne-Marie, I'm wondering what you think. The idea that supplies are outweighing some of the demand. We heard that today from a couple of different groups, including OPEC.
Well, what's interesting what's going on is the fact that you still have oil under pressure when there's hostilities in the Middle East. The fact that the Houthis still remain to be able to hit vessels going through the Red Sea, and you have supply having to take this very long, cumbersome journey around Africa, yet oil is still holding up. Like it's lower. How much lower would it actually be? I continue to remain if we saw no hostilities. And a lot of this, though, of course, has to come down to China. Well, until demand gets back in China, this is where levels are going to be.
And it highlights how the demand in the U.S. has been so different from elsewhere. And we've been talking about that all morning. This idea that the U.S. kind of stands alone when it comes to some of the exuberance. And we see the U.K. falling into recession. We see Japan falling into recession. Man, markets don't care.
Our markets here don't care, and even abroad, they're sort of fairly phlegmatic in that regards. The rates market has responded in the UK. We've gone to like nearly 80 basis points of a cut in the UK from 60 bips yesterday. So there has been a reaction function in that. They're going to have to go, well, maybe they will have to go a little bit earlier and a little bit more size than we presumed just a week ago. Inflation as well this week in the UK came in a little bit better behaved. So, you know, there's a couple of different facets going on in the UK, and then the European economy, and this is where the rates narrative might shift. We may have a shift. We've been talking myopically about the US, UK, and Europe. Now we will talk perhaps about a more concerted monetary policy reaction function, perhaps a little bit earlier and more in size than we anticipated.
Well, I think we should talk about that. Under surveillance this morning, the UK sliding into recession.
I think the big change is that we've moved from how restrictive do we have to make policy to get back to target sustainably to for how long do we have to maintain this stance of policy to achieve that, and that's an important. Services inflation is still above 6%, so that is not compatible with a 2% sustained inflation target. It's got further to go.
Here's the latest. UK GDP falling 0.3% in the fourth quarter of last year, sliding into a technical recession, and showing the BOE's campaign to bring down inflation is taking its toll. According to data this morning, Japan is also the latest country to slip into recession. The economy now falling behind Germany to become the fourth largest in the world. Joining us now to break it all down, let us know what we're missing, Gilles Moek, chief economist at AXA. It looks like a recession. It sounds like a recession. Markets aren't treating it like a recession. Do you have an explanation?
Because it really doesn't feel like a recession, on the ground at least. Because here we're talking about the European definition of recession, 2 quarters in a row of contraction in GDP, which is what we had in both the UK and Japan. But my guess is that if we were to use the NBR's more holistic definition of what's a recession, I'm not sure the UK would qualify. I'm not sure that Japan would qualify, because one key ingredient which is missing is the reaction of the labour market. And what we've seen is actually the opposite. In the UK, the unemployment rate remains extraordinarily low, even by historical standards. And what makes the Bank of England's job very complicated is that we've had concerning news about the resilience of wage growth. So it's a very strange situation where, yes, indeed, activity is stagnating or slightly contracting, but there is no impact whatsoever on the way the labour market has been operating. So I think that if you ask people on the street in the UK, they would probably complain about the level of interest rates. They could complain about the difficulty to buy houses and so forth. Would they treat this as a proper recession? Well, as long as the probability of losing one's job remains limited, they probably don't see it as a recession.
What would the prospect of, good morning, Gilles, we're pricing at 80 basis points of cuts before the end of the year. That's up from 60 basis points. So we've had a little bit of a jolt in the rates market. To what extent would 75 basis points of rate cuts in the United Kingdom dramatically change or significantly change the growth trajectory? If Japan is in recession, Europe is in recession, the US, goodness knows, might even slow down, Gilles. What impact would those rate cuts have, if at all?
No, you're right in the sense that we're talking about a fairly, muted response from monetary policy at this stage. So with 75 or 80 bips worth of cuts, you would move from very restrictive to restrictive stance, which would not necessarily change the overall picture. I still think that there's one signal, at least, that the Bank of England could give by cutting rates even moderately, which is on the housing